Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Hope all of you had a fantastic weekend. Start of a new week. Markets, of course, are going to be the focus. We're coming to you, as always, from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, hi, good morning.
Hi, good morning. And so much this week, right? There's the US Fed meeting. There are auto sales that are going to happen this week. There's a remainder of the earnings season. And it is a truncated week, so we have a holiday midweek. So lots to talk about.
Well, that's right. Lots of action in the stock markets. And what about the heat, guys? Very, very hot, right? I mean, yesterday I was in, I'd moved out of Mumbai, went to Karjat, went to Pune. It's so hot. I mean, and May is still not here. So yeah. I think we're bracing for a blistering May, I guess so.
It's a cruel summer. I was told there's a song by that name.
We'll figure that.
Swifties like it.
Really? I'm not a Swiftie. I'm too old to be a Swiftie, actually.
Neither, but you know, you're around kids and you hear all kinds of stuff. But anyway, it is a hot summer, a cruel one, maybe even. Well, let's just quickly tell you what you like to sort of, what you need to know actually as you start another week, start another day, right? And you basically have... we'll start where we left off on Friday, and especially from Wall Street, because that's essentially the handover. You basically had a good handover from Wall Street, and I'll tell you why. You had equities which went up, yields which were lower, and all of this was backed, or rather was on the back of core PCE number, which came in line with expectations. It was not soft, it was not weak. But it was in line with expectations. And the reason why the markets took it with both hands, because the last two inflation prints which came in, both of them were actually above expectations. So the market was actually bracing in for an ugly surprise once again. It was not ugly, it was not weak, it was in line, and the market took it in a bit more positive kind of a way. So yields went down. The 10-year lost about 4 basis points or so. And as a result, you saw the bigger move coming in on NASDAQ as compared to the S&P. The NASDAQ was up about 2%. The S&P was up only half of that, about 1% or so. Now, the dollar index, it is back above the 106 levels, so almost a 0.5% move. And that's pretty large, right, for that one. Big move in the USD JPY currency cross. Yen continues to go lower and lower and lower. I mean, you know, it's basically past that pair is past the 158. Actually, this morning, it's on your screen. It's past the 159 levels. At what level will you see the Bank of Japan coming in and sort of intervening? That is something which we will need to wait and watch. But I mean, you had the Bank of Japan meeting last week, late last week, and nothing came out of it. And that has basically triggered another large move on the downside for it. Oil prices, they stay a little above $89 a barrel, but you know, it's basically between this range, 87 on the downside, 91, 92 on the upside that we had recently. FOMC is the main event this week. I mean, if you're looking for a big market-moving event, it's that one. The Fed will meet on Wednesday. Wednesday, by the way, is a market holiday here. Doesn't matter, I mean, because the decision is, we'll react to the decision any which way on Thursday morning. But no change is expected. So will we see something on the margin? We don't know. But at the headline level, in terms of rates, policy, all of that, nothing really is expected. And perhaps it's going to be a consensus kind of a call. Support for the Nifty, just to sort of tie all of this back into levels. On Friday, we got a bit of a sell-off from the highs, right? So the support, I'll start there, stands at about 22,403. It's exactly where we left off on Friday. That's a 20-day moving average, but that did not break. So that kind of is the first pivot. Below that, and I think that is a more meaningful one, is the 40-day exponential average, which stands at 22,240. I mean, that is about 200 points away from where we are. The high of 22,620 will be the first resistance level. This is, last Friday's high. For the Nifty Bank, supports come in again at the 20-day moving average, which, by the way, is 47,937. We left off at 48,201. So, again, pretty close by, 1.5% or so, and you're there. And on the way up, the Nifty Bank targets this area between 49,057 and 49,100. So, I mean, both these are in the vicinity of 1.5 to 2.5%, both on the downside and on the upside as well. It's a big gap up this morning, at least that's the indication, about 90 points higher. And some of it, I'm assuming, is sort of in reaction to some of the earnings we got over the weekend. And we'll talk more about that as we go along. It's looked good. The markets showed us that it wants to go up more than anything else. You get these intermittent kind of pullbacks. But what it's also not been able to do for the last, I think, many weeks now is that once it gets to the higher bound of the range, which is 22,550, 22,600, it once again starts to cool off a little bit. It's not been able to take that out decisively. And this morning, with the GIFT Nifty indicating a start at about 22,645, you're once again in that zone. So we'll see once we start. Sonia.
Oh, absolutely. I mean, there's so much to track today, right? And looks like the bulls have the upper hand. So the GIFT Nifty is up almost about 90 odd points. So let's take it straight to some of the large cap names. ICICI Bank's numbers will go down quite well with the street. The numbers beat street estimates, and the deposit growth was very healthy, 20%. The loan growth was about 16 odd percent. And Jefferies put out a note where they said that ICICI Bank remains the top pick in the sector for them. So lots of bullish views coming in on ICICI Bank post its numbers. So keep that on your radar. The other heavyweight is Maruti. Of course, the numbers are below street estimates, so you could see some, red tinge over there. But by and large, most brokerages are saying that the margins were under a bit of pressure. Gross margins were down because the product mix was a bit weaker this time, lower amount of CNG sales. But by and large, the trend is still on the upside. So I won't be surprised if there's some buying interest in Maruti after the dip that we've seen. Remember, the stock has had a dream run in the last 12 months or so. Apart from that, I think on the flip side, you have HCL Tech, where the margins were very disappointing. It was not just a disappointing quarter for them, but the guidance was something that, won't go down well with the street at all. The FY25 revenue guidance was 3 to 5%, but the poll was 5 to 7%. So that's going to definitely take a back seat this morning. So these are some of the large numbers that you'd want to react to today. Overall, for the index, I think the trend is still on the upside. Yes, we are facing a bit of resistance at the 22,600 mark, but this has been an out-and-out buy-on-dips market, and there's no reason to suggest otherwise. So, the trend is your friend, as they say, and the uptrend seems to be intact. A couple of things to watch out for. The US markets were very strong on Friday. The Dow was up 150 points. The S&P 500 saw its best week since November. And this week, of course, there's the US Fed meeting, as Prashant was pointing out. So all eyes will be on that. For our own markets this week, two triggers. In terms of earnings, you have lots of, non-index, large caps, mid-cap favorites that are reporting numbers. There's Exide, Dabur, CEAT. There is Adani Power that reports numbers as well, so keep an eye out on that. And then you have auto sales too for the month of April. And of course, auto stocks have been everyone's favorite. So lots to watch out for.
Well, that's right. It's going to be a stock-specific market, Sonia. But as you said, yes, I think the Nifty's uptrend is still very much intact. But we're finding some kind of resistance at around the 22,700 odd mark. So that's one cue. The other factor we're looking at is the FI net short positions. Well, they have moved up again to around 1 lakh contracts. And the big cue for this week is going to be what the Fed is going to do. But let's get to the domestic cues first. In Friday's trading session, yes, the Nifty Bank, both of them ended a little bit lower. But I wouldn't be too worried. But actually, there was unwinding of long positions. We typically see this. If there's a big move on the last day of the previous series, on the first day of the new series, you see some of that get pulled back. And, you're returning back to the mean, basically. So no big worry with regard to the fall that we saw on Friday. What did the FIs do? Well, they are now net short, close to around 65% of their positions on the short side. And the short positioning went up by around 68,000 contracts. So the swing factor out there, because longs were 22,000 contracts, is around 40,000 contracts. So from being net short to the tune of close to around 60,000 contracts approximately, now they have moved back to around 1 lakh contracts. I'll tell you what, I would have wished that, in fact, the GIFT Nifty was suggesting that we're going to start off on the back foot. If that was the case, then that gives you that reason to go ahead and buy with the FI's net short. The problem today is a little bit more tricky because the GIFT Nifty is suggesting a 90-point uptick. So let's see how that goes. What are the levels we're looking at? Well, the reference point on the downside will be the 20 as well as the 50 DMA. So that's going to be the important marks on the downside. On the upside, and the reason I say that the upside, the 22,700 call could be the resistance level, is because the 22,500 call, it saw a fair bit of open interest. The premium was roughly around 180 to 200 rupees, which has come down to around 126 rupees. So the resistance is 22,700. The support is 20 as well as the 50 DMA. Those levels come up for you on the screen. The Nifty Bank, I think that could be a bigger mover in today's trading session because it's come down closer to around its support zone of around the 20 DMA. It's been facing resistance at around that 48,500 odd mark. So I think the Nifty Bank could be a relative outperformer for today's trading session. I'm looking at two stocks because the regulators were in action over the weekend, both the RBI as well as SEBI. And the stock that I'm looking at is AU Small Finance Bank because the RBI has issued the guidelines for voluntary transition from a small finance bank to a universal bank. So it ticks, all the boxes with regard to that. So AU Small Finance Bank is the one to track. Maybe it takes place in the next few years, but it's a sentiment positive. So it opens up to the green. What happens from there is what we need to see. And the second one I'm looking at is BSE. Remember, it's been the out-and-out performer in this market, but SEBI has directed them to pay higher regulatory fee on derivatives on the basis of notional turnover. So that's what could result in some EPS pullbacks. So that one starts off in the red. Let's see what happens from there. Two stocks, AU Small Finance Bank as well as BSE.
All right, thanks a lot for that. So plenty of stocks to talk about this morning and to react to. Let's get you some money market views. First up, B. Prasanna of ICICI Bank says the dollar remains strong as the Q1 GDP and March core PCE data in the US pointed towards persistent price pressure leading to delayed rate cut expectations. He says the dovish Bank of Japan also triggered a sell-off in the Japanese yen, resulting in weak Asian currencies. He says the rupee, backed by better macros and RBI's healthy reserves, outperformed its Asian peers, and rising crude dollar and geopolitical tensions will keep the rupee under pressure in the short term. Expects the dollar INR to trade in a range of 83.25 to 83.75 this week.
All right, on bonds, we've got B. Prasanna, who says that global yields remained under pressure as re-inflationary concerns gain momentum along with robust growth data. He says domestic macros, however, continue to exhibit benign inflation outlook, resulting in constructive price action. He expects the market to consolidate, with the 10-year benchmark bond yield likely to be in a range of between 7.15 to 7.25%.
Well, we've got a lot of stock-specific action track for you. Get to that in just a bit in our special Top 10 segment. For the time being, we're running through the list. We're looking at ICICI Bank, SBI Life, L&T Finance, NMDC, AU Small Finance Bank. All of them will be reacting to positive news flow. And we're split down the middle today. 5 expected to open up in the green, 5 in the red. So let's run you through the stocks that are reacting to negative news flow. Apollo Hospitals, Maruti Suzuki, HCL Tech, SBI Card, and IDFC First Bank.
All right, well, let's slip into a quick break. Actually, on the other side of the break, we'll tell you how to react to some of these names. ICICI Bank came out with their numbers, Maruti as well. So the street will definitely react to all of that. Our list of top 10 stocks is lined up in minutes from now. Stay tuned. Well, as promised, we're going to react to a lot of numbers now. ICICI Bank is the first one on our list. Abhishek is here to give us the lowdown. Abhishek, over to you.
Well, it's a mixed quarter coming out of ICICI Bank. The numbers are beaten up all. However, the core operating profit growth remains lower than loan growth for second quarter in a row at about 10.5% versus loan growth that you are seeing between 16 to 18% over the last 2 quarters. So loan growth YOY is the weakest in last 12 quarters and sequential loan growth is perhaps the weakest in last 11 quarters. Operating profit growth is at just 8.8% YOY, which is perhaps the weakest in last 11 quarters. Cost to income ratio, that's at 5-quarter low and first time below 40% as well. Gross NPA and net NPA ratio are perhaps one of the best that you are seeing in last 9 to 10 years, with gross NPA ratio at 2.16% and net NPA ratio of 0.42%. Now deposit growth, that's a heartening point to see. It's at 12-quarter high, both YOY and quarter-on-quarter. YOY it grew by 19.6% and sequential growth was about 6%. The subsidiaries PAT on a quarterly basis has crossed the 2,000 crore mark for the first time ever, and this time it was led by ICICI General as well as ICICI Securities. The risk weight to advances ratio is at the lowest that you are seeing in last 9 to 10 years or even more, coming in at 102.9% versus 114.9% in the previous quarter. In terms of our poll, PNL is slightly above our poll, but it was a weak poll to consider on the NII growth as well. PAT has beaten our poll given the fact that provisions have declined 31.5% quarter-on-quarter. Back to you.
All right, thanks a lot for that. I'm looking at 2 stocks this morning. One of them is Maruti. I'm going with red because the numbers were a mixed bag. As the operational performance disappointed the street, the margins were below street expectations. In fact, the margins came in below expectations because of lower CNG sales, a weaker product mix, and that resulted in 12.2% margins. The poll was 13.4%. Ex of that, there were no problems with the business. Revenue growth was very strong, almost 20%. Net profit growth of almost 48%. Nomura has a neutral with a target price of 12,523. They talk about how, despite having strong tailwinds, the margins were a miss this time. So that's a bit of a concern. And the market share may face a risk in FY 25-26. UBS has a buy with a target price of 14,000. The margin miss on UBS was led by a lower the margin miss for Maruti was led by lower CNG sales and higher costs, and is not a major concern according to UBS. But purely for today, I'm going with red, but I won't be surprised if the dips get bought.
Got it. We'll keep an eye out on Maruti, but let's focus on Apollo Hospitals. For many quarters, we have been waiting for this deal on Apollo Hospitals. And finally, post-market hours on Friday, it was announced. Ekta joins us to fill us in with a quick analysis. Ekta.
Thanks for that. Well, the news is that Apollo Health Co., which basically has Apollo 24/7, its online arm in its fold, as well as the pharmacy business, is going to be raising 2,475 crores or $300 million from the PE firm Advent. Now, they are going to be merging KMed, which is basically a promoter-owned wholesale pharma distribution business. If you want a comparison, for example, Intero, which just got listed, is a similar model to that, over the next 24 to 30 months. Now, they have said that the deal is going to be EPS accretive from year one. Now, one of the key things is that KMed has very low margins. FY23 margins were around 3.6%, though the company has said that it will eventually improve. Now, the deal also involves KMed buying out multiple JV partners. I was on the call on Saturday afternoon, and I think there are 19 outstanding partners as of now, and there are some of them which have been consolidated. Now, the positive is that they will be retiring around 890 crores of debt on their books. There will be growth capital for Apollo Health Co., which will come through. But they have a big target to achieve in terms of revenue. So for FY27, by year 3, they want revenues to hit probably 25,000 with margins of around 25,000 crores and margins of 7 to 8%. So it's a tall task at this point in time. And there were a lot of questions that, they'll probably have to do it via inorganic means. Now, also separately, they will look to grow the private label business via KMed's network of around 65-70,000 stores that they distribute to. And the EBITDA break-even for the digital business will be in 6 to 8 quarters. Now, one of the reasons why I'm going for red is that the margins for KMed is low. It's a very complicated deal, and the valuations of Apollo Health Co. is lower than what the street was anticipating. So that's the reason I expect the stock to be sluggish today.
Okay, in fact, we will discuss more on this fundraise. We'll have the management joining us on Bazaar today at 10 a.m. But the other stock that I'm looking at this morning is HCL Tech. Now, you can expect a deep shade of red on HCL Tech because the numbers were actually quite weak. It was not just a disappointing quarter, but the margin guidance is something that will not go down well with the street at all. The constant currency revenue growth was barely 0.3%. The EBIT margins were actually down 210 basis points. And the estimate on EBIT margins was 18.3%. It came in at 17.6%. But I think the guidance is something that will really disappoint the street. It's just 3 to 5% FY25 revenue guidance versus, 3 to 5% versus an estimate of 5 to 7% for HCL Tech. Now, this is on account of a 2% decline that they are expecting because of a large project moving offshore, and they see an additional headwind of 80 basis points because of the State Street BPO JV exit. So, a lot of brokerages are disappointed with the numbers. Jeffrey speaks about how the growth is quite weak. Kotak has cut their target price to 1,600 versus 1,730, and they talk about how the constant currency revenue growth is lower than what they estimated. In fact, we have the management on earnings joining us at 9:30 this morning. You'd want to listen into that conversation.
Okay, all right, that's about HCL Tech. But let's hop across to Sudarshan. He's here to tell us about SBI Life. Morning, Sudarshan.
Morning, Nigel. So I'm going with green for SBI Life as numbers were largely better than estimates and even better than the peers like HDFC Life and ICICI Prudential. And the reasons for this outperformance are, first, it was least impacted by change in taxation rules and had a normalized base to work on as compared to peers. Talking about the numbers, bottom line has seen a growth of more than 4% to rupees 811 crore. Annualized premium equivalent has come in 17% higher at rupees 5,330 crore, and it's better than the guidance company had had given in the interview to CNBC-TV18 after Q3 earnings. Value of new business has increased 5% to rupees 1,510 crore. VNB margin, though, has fallen 340 bps to 28.3%, but it's higher than the estimate of 28% and higher than the company's guidance range of 27 to 28%. On the guidance front for FY25, company says growth trajectory will be similar to what it has seen this year and will continue to outperform industry average and the growth of peers.
Okay, all right, Sudarshan, thanks a lot for that. Well, NMDC, that's a stock that I'm looking at. I've reached out to various buyers, and yes, they've confirmed that over the weekend, there has been a price increase that's taken place. But I'm not too sure about the quantum, so that's why we're attributing it to reports for now. The price increases of fines as well as calibrated lumpur has gone up by around 200 to 300 rupees. Just last month, the prices were cut by around 200 to 250 rupees. So in that sense, they have reversed the entire cuts that we saw. Now, why did these price hikes come about from NMDC? Few factors have played out. One, OMC, they have an auction that takes place, and out there they saw a good amount of demand with pricing move up. The second factor is when pellet prices move up, you normally see iron ore prices moving up. And global iron ore prices itself that's traded on the Singapore exchange, it had breached $100 per ton. That's moved back to around $118 per ton. So that's moved up by 15-18% approximately. So global iron ore prices moving up, that as well has given them reason to move up. And finally, iron ore prices moving up. The steel companies as well are trying to push through some price increases. So good on that. Just one contrary view is that the price increases that are coming about, maybe volumes get hit, but for the time being, the stock will open up well in the green. But going back to Abhishek. Abhishek, you're tracking a whole host of companies, SBI Cards, IDFC First, and L&T Finance. Please run us through the list out there.
Well, to begin with SBI Cards, the revolver rate has improved for the first time in last 8 quarters, coming in at 24% versus 23% in the previous quarter. Corporate spends have declined massively, and that's one of the reasons that you are seeing improvement in revolver rate. Net interest margin is at 4-year low or 16-quarter low of 10.9%, and annualized credit cost remains elevated at 7.6%. It's like Maruti ad khatam hi nahi ho raha hai. So 9-quarter high in terms of credit cost for SBI Card. Asset quality deteriorates. Gross NPA ratio is up 12 basis points sequentially. IDFC First Bank, the PNL is below pole, and guidance is of higher credit cost in FY25 versus 24. Let's take a look at the guidance. Credit cost guidance has been given at 1.65% in FY25 versus 1.3% that they had in FY24. Now, loan growth in FY25 is pegged at 22 to 23% versus deposit growth of 28 to 30%. So this can keep pressure on the CD ratio. And remember that 2 quarters back, the management had guidance for 25 to 27% loan growth for the coming year. However, that has been trimmed down. In terms of Q4 performance, risk weight to advances ratio is at 11-quarter high. ROA, return on asset, is at 7-quarter low. Asset quality has improved, and in terms of performance, the PNL is below pole. L&T Finance PNL is below Equirius estimate. However, business momentum has remained strong. So disbursements are up 24.8% YOY and about 3.5% sequentially. AUM growth is at 5.8% YOY and about 4.5% sequentially. It's heartening to see that there is AUM growth. AUM was on a declining trend for them for the longest time that I have seen. Net interest margin is perhaps at an all-time high of 9.14%. Asset quality, that's improved sequentially for them. Back to you.
Okay, khatam hi nahi hota hai. That's a nice one. It's a very, very financials, banking heavy day. We'll talk to lots of these managements as well. We told you IDFC First will be coming on. We'll be speaking with them. SBI Card is the other one. Abhishek outlined the numbers. We'll be joined by the management this morning at 9 o'clock as well. But as I said, it's a financials heavy day, and AU Small Finance Bank is the next one we're focusing on. Abhishek, back to you.
So eligibility criteria for an SFB to transition into universal bank as per RBI has been rolled out. So satisfactory track record of performance for a minimum period of 5 years. Satisfactory, they should have a net profit in last 2 fiscals, and shares of the bank should be listed on exchanges and with a net worth of about 1,000 crores. So should have gross NPA and net NPA ratio less than 3% and 1% respectively in the last 2 fiscal, and eligible SFB SFBs should have a diversified portfolio. This is a key criteria why many other SFBs may not be able to meet, especially Ujjivan, who has about 72% in MFI. So hence, AU emerges as one of the best placed in terms of, diversified portfolio and meeting all the other criteria laid out by RBI. So they can actually apply for a commercial scheduled bank license to transition from the SFB license that they have. Back to you.
Okay, thanks a lot for that. Well, let's do one thing. Let us take a quick recap, run through of our top stocks with positive news flow: ICICI Bank, SBI Life, L&T Finance, NMDC, AU Small Finance Bank, while stocks with negative news flow: Apollo Hospitals, Maruti Suzuki, HCL Tech, SBI Card and IDFC First Bank. But let's also get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in for all the action overnight. Manisha, hi, good morning.
Morning, Sonia. Thank you for that. Well, I'll start with precious metals, where we have seen some profit taking. Gold is open the week 0.5% down, and silver prices fell 7% in the previous week. We are looking at the U.S. data. That is what the markets are reacting to. The inflation numbers at 2.7% versus 2.6%. One is higher and much higher than the Fed's target of 2%. So that's bothering, and the strength in U.S. dollar because of that is what's weighing on to other commodities as well. The crude oil prices, after declining 3%, have started this week on a lower side as well. The U.S. monetary policy decision this week from the U.S. and the China PMI numbers are on radar. The one sector, though, that continues to do quite well for itself is the metal prices. Copper is now trading at $10,000 a ton. We are looking at 0.5% of gain onto that one in the Asian markets right now. Actually, all metals, whether it's zinc, aluminum, lead, are trading 0.5% on the higher side and making higher highs, higher multi-year highs as we speak.
All right, Manisha, thanks very much for that. That's commodities in focus. We'll take a quick commercial break here. We are back with Prakash Diwan. We'll talk about all these earnings, and there are so many of them, especially on the financial side, as I said. We'll also be joined by the management of the first company with us here. CSB Bank discusses their fourth quarter earnings and, of course, gives us an outlook as well. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good Monday morning. Well, to help us out with some fundamental analysis, Prakash Diwan joins us on the show. Hi, Prakash. Good morning and good to see you. Let's talk about the big boy, ICICI Bank. It's re-rated a little bit, but those return ratios and the numbers, they appear to be justifying the kind of run that we've seen in the stock. What's your view on ICICI Bank from here on?
Good morning, Rachel. So I think definitely very good numbers, and you would need these kind of numbers to justify the move that's already been witnessed in ICICI. Of course, when you look at it from a year-on-year basis, it's just about 20% that it's done. So the question that begs us is there more room for the stock to kind of show some sort of an upside? What these numbers tell you is that the bank, in spite of all the challenges on NIMs, on quality, asset quality, all of those counts, it's doing well, which means that there could be growth if the credit expansion happens across the board. But specifically, if you ask me, there's nothing very spectacular in the numbers that warrants any kind of a re-rating in the immediate short term. But yes, it kind of paves the way for a much stronger mid-term kind of a medium-term kind of a performance, which would probably take another 2 to 4 quarters. But otherwise, today's day, I think the numbers pencil in a lot of the goodness that's already in the price.
We spoke about Maruti as well, right? When the numbers just came on Friday. Your thoughts on how to approach it? I mean, there could be some disappointment because of the margins, yes. But do you think that the street will go in and, so buy into that dip?
Good morning, Sonia. Absolutely. So as I said, any kind of a sell-off in Maruti, given the miss in numbers versus expectation. And remember, on a revenue growth like this, on a absolute margin expansion like this, EBITDA expansion like this, you would kind of have to live with some sort of a reset because of the product mix. I would believe 12.5% kind of margins are a very good base to move on as they kind of start selling more premium cars. They have been doing that, but Maruti is always known to be very conservative when it comes to pricing. So if you typically look at the differential between its base models and its top-end models, it's probably the narrowest in any other, compared to any other OEMs. And that's the reason why they are not able to pass on higher prices in terms of incremental margin growth, and that will probably stay for a while. But I would believe the next big change in terms of the business trajectory is going to be hybrid, Sonia, and that's absolutely not yet reflected in the numbers, except for maybe one or two models which have started adding. But the Toyota collaboration is probably now reaching a stage where they will get scale as well. So I would definitely be positive on that. I mean, I've always been positive on Maruti. We've seen how it's done through the tough times. So any dip in the market would probably be a good buying opportunity for longer-term investors.
Prakash, hi, morning. What about BSE? That fee, how the fee is going to be calculated, not based on the premium and multiplied by the quantity, but basically based on the notional turnover. Now, how they pay, the amount that they pay on is a fraction, literally a fraction of the notional turnover. But now, of course, SEBI is saying that this has to be done. NSE already, by the way, pays on the notional turnover, and I think now the BSE will have to as well. So there are some estimates saying, there's a earnings impact naturally, unless and of course they increase transaction fee, etc. Just your thoughts.
Good morning, Prashant. No, absolutely. I think this was a little bit of an aberration that there's an attempt to correct it, normalize it, and it is definitely a setback in terms of what it ends up leaving for itself on the bottom line. There's also, apart from the impact on the EPS, which people could have different views on, my sense is that this reminds everybody of the of the regulatory risk that you end up carrying when you buy into a company which is one of the two players in the market, and it's always vulnerable to any kind of changes that happen in policy and regulation. So that's the reason why the premium could shrink, more than just an EPS shrink. So it's going to be a dual impact. EPS cuts in the short term, but a PE re-rating downwards, softness in the PE multiples in the medium to long term. So that you have to live with. And I'm sure there are lots of people sitting on lots of profits. So there will definitely be an impulse to book out after this news flow.
All right, Prakash, what about AU Small Finance Bank? This announcement that came in from the RBI is good news for them. The only question is how soon can they go ahead? Because they have a pending merger that's yet to take place. And also, I think reports are indicating that this conversion from a small finance bank to a universal bank may not be very, very soon. It could be a longer-term vision. The stock has been a rank underperformer. Your view on it?
Good morning, Nigel. So, yes, it's one of the most eligible bachelors in town to get into the mainstream bank club. But, the management itself has been very clearly advocating the cause for a slow turn, a slow shift into this, a slow transformation. I remember one of the interviews about 6 months back where Mr. Agarwal actually mentioned that we are going slow on this precisely because our balance sheet needs to get a bit much stronger in some of the verticals. So that might take time. But, it'll be interesting because it'll become a very good case study for all the other small finance banks to kind of morph into this as and when the opportunity arises and approvals come through. But whether the stock gets re-rated because of this, I don't think so. It's an intent that's been demonstrated, that's been articulated. There's a lot of work that needs to be done to actually make it happen. And as and when it happens, whether the profitability will take time to change, that's a big question. And the answer is it could possibly be much longer than what we anticipate. So I would, and financials are giving you so much of opportunities. Every day there is something or the other happening. You look at RBL Bank numbers, you look at ICICI endorsing its leadership position in most metrics. I don't think people will get too excited just because of this.
All right. Thanks for that. We'll do one thing. We'll come back to you in a bit, right? We have the market opening in about half an hour from now, the pre-opening that is. But moving on to the big exclusive interview, Prime Minister Narendra Modi sat down with Network 18's Group Editor-in-Chief Rahul Joshi and News 18 Network's Vilas Bade and Hari Prasad and discussed a slew of issues making news this electoral season. He spoke about the controversy around the inheritance tax and wealth distribution. Listen to excerpts from that exclusive conversation.
सैम पिट्रोडा जी ने जो है इनहेरिटेंस टैक्स की बात की, जो हम लोगों की जमा पूंजी है, जब हम अपने लोग पूरा बचाते हैं अपने फैमिली के लिए, जब हम उसको अपने आने वाली जनरेशन को देंगे तो उस पर भी टैक्स लगेगा और ये टैक्स बहुत बड़ा टैक्स हो सकता है। तो क्या आप कहेंगे कि बीजेपी अगर आएगी तो इस टैक्स को कभी नहीं लागू करेगी?
भारतीय जनता पार्टी क्या करेगी, हमारे मैनिफेस्टो में साफ हमने लिख करके लाए हुए। अब उन्होंने कहीं सगुफा छोड़ दिया तो मैं भी वो झंडा लेके घूमूंगा, ये सवाल आपके मन में कैसे आ जाता है? जी, भारतीय जनता पार्टी की विचारधारा साफ है जी। हम अपनी विचारधारा के आधार पर कार्यक्रमों को लेकर के, मैनिफेस्टो को लेकर के देश के सामने जाते हैं। कृपा करके ऐसे महाशयों के विचारों को हम पर मत थोपिए भाई।
मोदी जी, राहुल गांधी ने एक बात और कही है। वो कहते हैं कि जब वो सरकार अगर उनकी आएगी तो वो एक नेशनल एक्सरे कराएंगे। इसी से जुड़ा सवाल है, इसीलिए मैं पूछना चाह रहा हूँ। एक नेशनल एक्सरे कराएंगे, बात सिर्फ कास्ट सेंसस की नहीं है जो कि वो करते आए हैं, उस पर भी मैं आपका मत जानना चाहूँगा, मगर बात वो कहते हैं इससे आगे है। बात कास्ट की नहीं, बात जस्टिस की है। और वो कहते हैं कि हम जो है एक सोशियो इकोनॉमिक सर्वे लाएंगे, एक इंस्टीट्यूशनल सर्वे लाएंगे और उसमें देखेंगे कि किसके पास किस जाति और किस उस वर्ग के पास क्या है, कितना धन है, कितनी इंस्टीट्यूशंस में भागीदारी है, और उसके बेसिस पर हम इस पूरे सिस्टम को रीडिस्ट्रीब्यूट करेंगे। इसको आप कैसे देखते हैं?
सबसे पहले तो इस देश में जो लोग अपने आप को राजनीति के एक्सपर्ट मानते हैं, जो लोग देश के उतार चढ़ाव को बड़ी बारीकी से अध्ययन करते हैं, सबसे पहले उनका दायित्व है कि वो ऐसे लोगों को पूछे कि जिस परिस्थितियों का वर्णन आप कर रहे हो, अगर ये सही है तो 50, 60, 65 साल तो आपने राज किया भाई। ये मुसीबत के जो जन्मदाता आप हो और आपने अब तक ये बर्बादी लाई क्यों? पहले उनका जवाब मांगो भाई, नंबर 1। नंबर 2, एक्सरे का मतलब क्या है जी? मतलब हर परिवार में जाना, घर घर छापा मारना। अगर किसी अनाज के डिब्बे में किसी महिला ने अपने गहने छपा के रखे हैं, उसको भी एक्सरे किया जाएगा, उनके गहने ले लिए जाएंगे, जमीनों का हिसाब किताब किया जाएगा और फिर उसको रिडिस्ट्रीब्यूट करेंगे। ये दुनिया में एक माओवादी विचार ने सब किया हुआ है, दुनिया बर्बाद हो चुकी है जी। ये पूरी तरह अर्बन नक्सल उस सोच का सीधा सीधा प्रकटीकरण है। और इसलिए मैनिफेस्टो आने के 10 दिन तक बाद भी ये जो जमात आए दिन लिखापट्टी करती है ना, वो चुप रही, उनके प्रोटेक्शन में चुप रही है। तब मिलके मेरी जिम्मेवारी बन जाती है कि देश को जगाना कि भाई देखिए आपको लूटने की ये तरकीब हो रही है। और दूसरा पार्ट है, डॉक्टर मनमोहन सिंह जी वगैरह, उन्होंने हर बार कहा है कि भाई जो भी संपत्ति होगी इस पर पहला अधिकार किसका होगा। तो हिसाब किताब बहुत साफ है, वो क्या करना चाहते हैं।
All right, that's a mega Network 18 exclusive. You can watch the entire thing tonight at 9 p.m. Prime Minister Modi addressing a lot of issues and, of course, talking about the way forward post the election. So do tune in to that entire conversation across all the Network 18 channels. Okay, let's get back to tracking markets. Let's focus on CSB Bank now. The problem is their asset quality saw a big deterioration in Q4. Slippages are also elevated. Their corporate book has also shrunk, although deposit momentum is strong. Pralay Mondal, who is the Managing Director and Chief Executive Officer at CSB Bank, joins in now. Mr. Mondal, always great speaking to you. Good to see you in this morning. Of course, the first question that shareholders would want to know is the deterioration in asset quality. Can you tell us what led to this surge in slippages? Was it any one-off this quarter? And what is the average slippages that the bank would have over the next few quarters?
Good morning, Sonia, and your viewers. Absolutely relevant question that our gross NPA and net NPA did slip a little bit this quarter. But as you rightly said, it is a one-off. There was one account which has a coverage of around 70 crores with us right now, outstanding. And for some technical reasons, it slipped this quarter, though it was not in our watch list at all. So that's why we didn't discuss it last quarter. Otherwise, we would have given disclosure. And we are pretty confident that we will reverse this in the definitely in this FY and hopefully in the next 2 quarters. So this is something which is not worrying us too much overall. And if you take this out, now how does it impact the overall NPA? There is 18 crore in terms of provisioning because we do 25 crores provisioning. And there's another 2 crores of around interest impact, which overall takes it to 20 crores. If you take that 20 crores out, I think overall GNPA, NNPA, PCR, the coverage ratio, all of that looks typically the way we have been covering for the full year. On your second part of your question, that how do we see next year? Next year, we would be in line with what we had been till Q3 this year, which is gross NPA will be similar to where we were, and net NPA and coverage and slippages will be similar to what we are till Q3 FY24. So this was an exception, and this we will recover from this very quickly.
So you're saying the slippages on an average will be what you did in Q3, which was around 40 crores odd. That would be the average that you're looking at over the next couple of quarters? Or will it be much higher than that?
On a percentage basis, yes, on a percentage basis. And overall GNPA will be somewhere between 1.3 to 1.4. And NNPA will be somewhere between 0.3 to 0.35. And we will be back above 70% in terms of our PCR, which is the coverage ratio. So we're pretty confident of that. And while we're talking about credit cost, our credit cost for the full year basis was still negative, 2 basis points negative. So it has not really impacted the overall yearly numbers. And we hope that next year also our credit cost should be below 10 basis points.
Oh, wow. Credit cost for FY25. Pralay, hi, morning, Prashant here. Credit cost for 25 to be under 10 basis points. You don't think this will, that is exceptionally low? You don't think that will sort of normalize, much normalize? You know, we had Amitabh Chaudhary with us, I think one of the interactions I think it was last quarter. Of course, in a different context, he was saying for the banking sector, credit costs will normalize. I mean, it has to normalize. I mean, these are very, very low levels we're at. So I just sort of contextualize that in the context of CSB and then also talk to us about NIMs, net interest margins. What's your sense for that for FY25?
Yeah, thanks, Prashant. No, you are right. I mean, the bigger banks will have more normalized kind of numbers. For us, we must appreciate that for more than 45% of our portfolio is gold loans, where the slippages and NPA is very low. Credit costs are almost close to zero. So to that extent, it helps us. Also, if you look at the last 2 years, we have been closer to zero in terms of our overall credit costs. So I'm being pretty conservative when I'm talking about 10 basis points in terms of credit cost next year. Hopefully, will be lesser than that. Coming to NIMs, yes, you're right. I think the entire banking system is going through a little bit of a transition on the NIM because deposit costs have gone up for everybody. That is true for us as well. Our NIM has come closer to 5% now. And next year, I think will be somewhere between 4.5 to 5, closer to 5. And that's primarily because of two reasons. One is some tail of the deposit cost will continue to impact the entire ecosystem, including us, for another quarter or so. But that will be not much. The other reason is we also are gradually planning to shift our asset book gradually more towards wholesale, SME, retail, because today the gold is almost 48%. So to that extent, I think the NIM will get little impacted, but it will be compensated by our overall fee income and fee businesses. And hence, from an overall ROA perspective, which we closed this year around 1.79, I think we should be able to hold close to that.
All right. Hi, Mr. Mondal. So 4.5 to 5%, but closer to 5% is the NIM guidance. We got that. You know, there's another player in the gold business, which is IIFL, and they have been wrapped on the knuckles. Have you seen any kind of shift towards banks? Has that been more inquiries for your gold loan business?
Good morning, Nigel. I think we are in a different segment of business because typically the interest which we charge our customers are in the range of 12, 12.5 or even lesser. And NBFC's interest rates are almost 50% higher than us. So to that extent, the segments which you're talking of are very different. So it will not necessarily give us more business. The second question which Prashant had asked, I think I just sort of wanted to allude to is overall, I think the wholesale side of the business will grow for us next year, and SME also will grow next year. So to that extent, the gold portfolio impact will be a little lesser, and hence overall our balance sheet will look a little more balanced from that perspective. But coming to next year growth, I think gold growth will continue to grow for us, but not at the cost of others. We have our own ways of building our portfolio, and we'll do that.
Okay, all right, Mr. Mondal, besides the numbers, we spoke to you a couple of weeks ago as well. I just wanted to ask you, is there some inorganic growth plans? Because there is some kind of buzz that maybe CSB is on the prowl, and maybe one of those PSU banks could be on your radar. It's happened in the past, I recall, with Bank of Maharashtra, I think so. And what about, are you all on the prowl again? Are you all looking at any PSU bank?
See, purely from a CSB perspective, I can tell you that we are building the bank completely organically. I can't answer on behalf of Fairfax, who's an investing company, and they can look at whatever opportunities they want to look at. But from our perspective, we are clearly looking at organically growing the book. And if you look at our biggest investment this year is into technology, and most of our technology investments are not in line with the bank you're talking about. Our core systems are different. So to that extent, had I known that there is something happening, then we would have done it differently. So very clearly, we are organically growing our bank right now.
All right. Thank you very much, Pralay, for joining us. It's a pleasure, and it's always nice to speak with you. Good luck, and speak again. Thanks very much for joining us. That's CSB Bank, and running us through some guidance for FY25. Absolutely fantastic. The stock's done phenomenally well. Last, I think, 1.5 years, it's basically doubled from under 200 to nearly 400 now. And, they seem to be on a pretty solid, steady track, very strong net interest margins, and continue to hope to be around that 5% level, 4.5% to 5% numbers, even as they continue to balance the book, so as to speak. Prakash is still with us. Prakash, just a quick word on tech, right? Tech, Mahindra saw that very large move on Friday. HCL Tech, I'm not sure. I mean, I think it's a bit disappointing, especially the guidance, as Rima was telling us earlier as well. Just your thoughts here.
So, Prashant, my stand is very clear. The big guys will definitely struggle because it's not very easy to transition into a newer business model with, cutting edge prowess on the AI side. Whereas there's a lot of the other work that gets kind of left out in, especially the ENRD kind of space. So look at what a Persistent has done. Look what a Scient has done. Look what a Sonata could do, given its platform strength. So there are businesses which are far more nimble, and they'll be opportunistically able to grow business at very decent margins as compared to the HCL Techs and the TCS of the world. So I would still believe that the allocation will predominantly go into those mid-cap or tier 2 IT names rather than the big ones. So there could be, in fact, more money moving out of these names like HCL Tech and all, given the disappointment. So you'll probably not have any kind of a PE expansion that you could expect. And then, of course, EPS expansion is still some time away. So I would look at this very differently, be more stock specific, bottom up in terms of business models in the mid-size IT rather than the large.
Okay, let's do one thing. Let's take a quick commercial break. On the other side, Mitesh Thakkar and Sudarshan Sukhani will join in for a technical setup. Do stay tuned in.
Okay, welcome back. 10 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they'd want you to do this morning. Gentlemen, great to have both of you here. Mitesh, to you first. We're kind of once again open right in that resistance zone. What's the trade, if there is one at all, on the Nifty? And then we'll talk about stocks.
Morning, Prashant. See, the GIFT Nifty is indicating about 90 odd points kind of a gap up, and therefore I think we might not want to take a trade on the index. 22,400, 350 on the spot is my support area, which is where we closed on Friday. And 22,600 is the first supply pivot on the hourly charts, and then 22,730. So I think broadly it is a market which is not looking weak, but that extra burst of momentum is not there. So if you get an intraday dip, maybe then explore some kind of buying. But yeah, broadly trading with long bias on stocks.
Okay, long bias on stocks. Sudarshan Sukhani is also with us. Sudarshan, how are you feeling about the market? Do you also have a long bias? And if yes, what are the stocks that you're looking at today?
Yeah, good morning. See, there is a mild bias on the long side for the Nifty, and that means every opportunity for an intraday dip should be used to go long. Now, the broader picture is that the Nifty is entering into a consolidation for the next 1 or 2 weeks. Within that consolidation, the trend is still up. You can see we are at 22,400. It's not a joke. It's pretty high. So within that uptrend, stay on the long side, buy every dip in the Nifty, take small profits and quick profits. Stocks are a different matter. Almost everywhere the stock signal is only for buying because there are so many stocks available. Some of them are always going through a dip and recovering from that. Alchem is a buying opportunity. Buy with a stop under 46.40. Cipla is another buy. A trading range is breaking out. Stop under 13.46. Pidilite is my third buy choice. Again, stop under 28.35. And TechM, which is probably likely to outperform the other IT stocks, is a buy with a stop under 12.25.
Okay, all right. Thanks for that, Sudarshan. Mitesh, what about you?
Morning, Nigel. I also have more of buy calls. Aurobindo Pharma is on the buy list after consolidation. It's coming out. So buy with a stop below 11.15 for targets of 11.65. Godrej Properties, buy with a stop below 25.95 for targets of 27.20. Also buy on Marico, which I would recommend buying with a stop at 5.10 for targets of 5.30, and one sell call. See, IndusInd Bank had a very negative kind of a breakdown on Friday. So if it continues to trade below Friday's low, I've kept 14.40 as the trigger. Then go short with a stop at 14.61 for a first target of 1400.
All right. Chandan Taparia is also joining in to give us some F&O cues for the day. Chandan, hi, good morning. What are you looking at on the index and what are the individual stocks you're tracking today?
Good morning, Sonia. Thanks for having me. So index got stuck in a broader range of 1,000 points from last couple of weeks. We have noticed that from last 10 weeks, it has been moving in between 21,700 to 22,775. But major trend is intact on positive side and every small decline is being bought. So overall, we are expecting that market is forming the higher base, and because of that, next leg of rally cannot be ruled out after the consolidative move of next couple of days. So we suggest to buy any small decline with major support of 22,222 and expecting this rally to head to us 22,775 and 23,000. So looking for buy on decline and expecting next leg of rally after some consolidative move of next couple of days. Now looking at the data set of volatility is holding at lower level. Put call ratio is hovering near 1. So both are indicating overall that bulls are having dominance in the market. Now looking at the Bank Nifty index, we have witnessed a swing of 1,000 points in the last week. Technically, it formed a doji sort of candle, or we can say small bodied candle where higher shadows are there. So that clearly indicates the declines are being bought. And we believe that with support of 47,777, Bank Nifty has potential to again reclaim the lifetime high of 49,000 marks. Now looking at the stock wise, first it is buy on IRCTC. We have positive stance on Nifty CPSE index. So positive on the railway, power, energy, defense. So first it is buy on IRCTC from the railway space. It has been making higher tops, higher bottom on the daily scale. We have seen 96-97% rollover with built up of long position, which indicate fresh leg of rally. So one can buy with support of 1,025, and IRCTC has potential to rally to us 1110 levels. Second trading area, that is buy on Motherson Samvardhan. It has formed a higher base, holding the key support zone. We have seen some short covering move with rollover of more than 97-98%. So one can buy with support of 129, expecting a rally to us 138 to 140 zone. Last trading area, that is buy on Tata Power. We have seen a consolidation breakout of last 9 trading session. It has formed the higher base at 425, which indicates fresh run up towards 460. So one can buy with support of 413 Tata Power.
Okay, Chandan, it's always a pleasure. Thank you very much for joining us and running us through what you're making of things there. We'll take a quick commercial break here. There's market open, the pre-open, which is 5 minutes out. So we'll get to it in just a bit. Stay with us.
Co-powered by
Welcome back. We have 18 minutes more for the markets to open, and Prakash Diwan is still sitting by. Prakash, this week you have a lot of interesting numbers coming out. There is CAD, there's Dabur, there is Exide, Adani Power, and some of these stocks like Exide have done exceptionally well. Any thoughts? Would you want to buy into any of these names ahead of numbers? Oops, I think you're on mute, Prakash.
Sorry. So, out of the numbers expected this week, I think very clearly Dabur is the one that I would look at whether there's any indication of a turnaround or a bottoming out, if you will, of the slowdown in rural consumption. We've seen the numbers from HUL be disappointing. We've seen Nestle being very hum and oh, but these are different product mixes, different segmented products that they have. But Dabur is probably a very good proxy to what's happening in rural India. And if that is going to be some indication, look at how undervalued the FMCGs are. They're under-owned, they're undervalued, of course, for some reason. But there could be a very different re-rating that could be starting off with the monsoon coming on time, with election spending also percolating down to the bottom of the pyramid. So there are lots of factors which could actually turn positive. Dabur numbers are the ones that I'm very keenly watching. I might not want to buy into it given the fact that it's still not out of the woods, but those numbers will definitely be very interesting to track and act upon.
Okay, all right. I think Prakash is, of course, just a quick word on, I'm looking at the note from IIFL. Let's just put a BSC. Actually, the pre-open will tell you the reaction there. There was, I think, the HDFC Securities note, which was kind of more, I think, the cut that they estimated on earnings was smaller, but the IIFL note, I mean, they're saying EPS could be hit by almost about 35-40%, and you'd need a similar kind of increase in transaction fee to kind of hold on to what they're making right now to maintain that level of profitability. Which then kind of works in the opposite direction of trying to gain market share from NSE. So this is, looks quite damaging, at least right now. We'll try and get in touch with the management of BSE to better understand. But as Prakash earlier told us, this of course does bring to fore some of the regulatory risk that many have been actually talking about. Prakash, just coming back to you for more, but I think we have SBI Cards ready with us.
Well, yeah, that's right. Let's get straight to that one. Then SBI Cards, the Q4 numbers, well, the revolver rate improved a little bit for the first time in 2 years. Their corporate spends, though, have declined massively, while the net interest margins continues to fall to multi-year lows. Well, we're joined now by Abhijit Chakraborty, the Managing Director and CEO at SBI Card. Hi, sir. Good morning and good to see you, Ben. Well, two-part question. One is on the corporate spends. They've seen a sharp decline. Was it by design or was it due to demand? That's point number one. And the revolver, the percentage has finally moved up, even though it's only around 100 basis points at around 24%. Where do you see this number headed?
So corporate spends is a bit by design. Post RBI guidelines that came in during mid-February, we saw that there is a compliance requirement on the part of the vendors to be onboarded as merchants. And till that was happening, we wanted to be on the right side of the lines, and that's where we went slow on that business. Now, as and when we are seeing that the vendors are getting onboarded as merchants, we will be progressively moving towards that business. And during Q1, we will be building up that book again. And Q2 onwards, we will be back on full stream on the way we were doing earlier. So that was definitely by design. Coming to revolvers is has improved, and revolvers will be a function of the quality of the customers that we have. And there is a tendency from the customers to rather go for EMI-based payout rather than continue to revolve over a prolonged period of time. So we encourage both. That's where our total interest earning assets have been growing, and year on year it has grown by 4%, and it continues to remain steady at around 62%. So our total interest bearing book is very steady and constant, and revolver will continue to prevail around these rates.
You don't see it move up closer to around the high 20s, sir? You know, because that's a trigger for the stock market perspective. They would like to see the revolver contribution moving up.
As I said, we will be definitely looking at a higher number, but then it's the customer preference. If they prefer to move over to EMIs, a larger portion of them, we will encourage that also. But because ultimately it's the overall interest income that matters to me. My loan book, my interest-bearing assets from my overall receivables should be on a stable path, on an increasing path. Revolver is a mixed part of it. We will be watching it closely.
Mr. Chakrabarty, hi, good morning. What is the share of spend via these, what you call BPSP, what the RBI had kind of intervened on earlier? What is the share of that as a share of spend, percentage of total spends?
That will be, say, around 15%, because my retail spends constitute the larger share of our spends, and we have grown 25%, over 25% on the spends year on year. And it's the retail spends which is my strength, and we continue to encourage it, and it's going to build up further.
No, got that. But so you're saying, so corporate spending was about 25% of the total, right? And you're saying that this particular segment was about 15%.
It will be around 15% all taken together, and largely it will be coming back in the coming quarters. But as I said, the retail spends will be continuing to be around 80%, and we will continue to build it up.
Okay. What about credit costs, Mr. Chakrabarty? What should we expect? Because there has been a bit of stress. Could you give us some guidance, some outline for FY25? Where do you want it to be?
Yeah, the stress we had indicated, we had taken corrective actions. We find that our recent acquisitions for over the last 1 year are behaving much better than their peers in the previous years. So overall mix is going to improve. We have taken various actions on our existing portfolio. So while there will be a slightly elevated credit cost for the near-term quarters, but then over the period of next year, it's going to taper down, and we expect it to remain around and above 7%, but then it will be coming down from the current levels, definitely.
Okay, I had two questions. One is on net interest margins and the other one on asset quality. Your asset quality pain continues for the longest time. Any update on how things are going to move from here?
So as I said, the asset quality, we saw a stress in the portfolio, which was largely because of the overall ecosystem where the constituents who had taken card from us in earlier period, they went into concurrent borrowings, and they developed various trade lines, and they somehow have a limited capacity to pay. So based on that, we have seen there is a stress, and that money will come back over a period of time. But then in the current scenario, the stress is going to remain for some time. On the margin front of it, we expected post-November RBI intervention, we expected the cost to go up a bit, and we did go up by 20 basis points, but then that has more or less stabilized. And with the rate cuts that were expected not coming in, we see that rates margins to remain stable, and even if there is a marginal increase over a period of time in the coming quarters, we will be able to pass it on to our asset.
Two numbers, right? I mean, you spoke about credit costs earlier. I got that. On your gross NPAs, what is your number for the full year FY25? And also on your margins, you give us a qualitative number, but quantitatively, what can the NIMs be by the end of FY25?
So NIMs will prevail around the current level. We closed the year at around 11.3%. So we expect that it should remain around these levels only, because as I said, we'll be whatever increase, if it is there, we'll be able to pass it on. And coming back to GNPA, we closed the year at around 2.76%. We will be able to contain it around these levels. Because as I said, the mix of the accounts as it goes forward will help us in containing the GNPA to around the current levels.
All right. So I wanted your view. You know, Kotak Mahindra Bank, they're in the dock post the RBI wrapping them on the knuckles with regard to the credit card business. They're a much smaller player. But your new card acquisition, I think it's moved down to around 1 million per quarter. Earlier, it used to be higher. What is the strategy on new card addition? If you could give us a guidance on a quarterly basis, it used to be 1.3, 1.4. For the past quarter, it was around 1 million. Going ahead, how do you see it move? And do you see incremental market share gains because a smaller player is likely to be contained now?
So our strategy for the quarter-on-quarter growth on incremental accounts, card accounts, will be around 1 to 1.1 million. Reason being, January 23 onwards, when we saw there was we were required to intervene in the portfolio, change our acquisition strategies, and we did tighten up our acquisition policies a bit. So that has an impact on our overall acquisition, and that's where from 1.3 million per quarter, we saw it coming down to 1.1 million. So this is definitely going to happen. 1 to 1.1 million is definitely going to happen. But regarding any market space available, I don't think we will be looking at it. We will continue to look at our policies, our acquisition strategies. Based on that, whatever acquisition comes within our policies and strategies, we will be continuing to focus on it.
Okay, all right. We leave it at that. Thanks a lot for joining in. I appreciate your time here on CNBC-TV18. That's SBI Card. By the way, we have lots of stocks in focus, so let's get back to that very quickly. The top stocks to look at in pre-opening, of course, are ICICI Bank and HCL Tech. ICICI Bank numbers actually beat street estimates. There was a healthy deposit growth and loan growth. So in pre-opening, if we can just get the stock up for you, it's flat with a bit of a positive bias. HCL Tech is the one that disappointed quite a bit. So HCL Tech revenue guidance was disappointing. The stock is down about 3%. I'd also want to watch for Tech Mahindra because Morgan Stanley has upgraded Tech Mahindra to an overweight. They have a target price of 14.90 and Tech Mahindra came out with very good numbers. So that one is up almost about 1%. But Sudarshan is back with us. Sudarshan, what's the big call at 9:10?
Well, consider buying Tech Mahindra, Tech M, with a stop under 12.25.
And Mitesh, what about you?
Yeah. I'll go with the buy on Marico with a stop at 510 for a target of 530.
Okay, let's go across to Nimesh now to find out the standout brokerage report of the day. Nimesh.
Hi, Sonia. So today there are two reports which stood out for me. One is both from Morgan Stanley. First is on Interglobe, where they've sharply raised the target price. And second is on Tech Mahindra, where they've put out a double upgrade to overweight. Now, starting with Interglobe first, Morgan Stanley has an overweight stance, but they further raised the target price now to 46.15 versus 41.45 earlier. They see a very large total addressable market as well as sustainable mode for the company going forward. As far as the total addressable market is concerned, Airbus expects the domestic passenger growth to be fivefold by 2042. Overall, domestic plus international passenger growth will be from 221 million passengers in 24 all the way to 370 million by 2030, which means a 9% CAGR over the next 7-8 years. In terms of moat, Indigo's CASK is much lower than global peers. The efficiencies at scale, on-time performance was the best in CY23, and even the network is becoming a kind of a moat for Interglobe going forward. So these are the few reasons why there is a big upgrade in target price on Interglobe. The second was on Tech Mahindra. Morgan Stanley has actually double upgraded the stock to overweight from underweight, and sharply raised the target price to 1490. They believe that after the last quarter numbers, capital allocation, growth outlook, as well as margins sets the floor on the stock at around 1150. In fact, from here on, the key triggers to watch would be margin improvement quarter on quarter, revenue improvement YOY, as well as diversification from the telecom businesses will be the key catalyst. So a big double upgrade on Tech Mahindra and sharply raising the target price on Interglobe. So both stood out for me from Morgan Stanley notes.
All right. Thanks very much for that. So keep an eye out on those names as we begin this morning. There is 4 minutes to go for market open. 55 higher on the Nifty, and you got about a 250 odd point higher start on the sensex. But the other ones on the downside to watch out for are BSE and MCX. Vamakshi is here revisiting these names. Vamakshi, hi, morning.
Well, good morning, Prashant. Yeah, well, yes, BSE and MCX, both of these counters will be in focus, and that is because over the weekend we saw that the companies have been asked to pay regulatory fees to SEBI based on annual turnover calculated from the notional value of option contracts. Now, the key word out here is notional turnover, because the companies were calculating the annual turnover based on the premium value for the options contracts, which is much lower. So, therefore, the companies have been asked to pay a differential regulatory fee for the past period along with interest. For BSE, this amount is up to 165 crores, which includes that for the past year as well as the current year, while for MCX, the differential fees amount to nearly 4.5 crores. Now, brokerages have also come out with their reports. We have Jeffrey saying that the EPS could be impacted by almost 15 to 18% as derivatives volume growth remains ahead of estimates. Price hikes could be anticipated, premium quality could improve, and this in turn could fully offset the EPS impact from this announcement. After building in a partial price hike of nearly 15%, they've gone ahead and cut their FY25 and 26 EPS estimates by around 6 to 9%, which actually leads to a lower target price of 2,900. They've downgraded the rating on this counter from buy to hold. Apart from that, Morgan Stanley says that the differential fees could be expected at nearly 4 crores in FY25, which could impact its PBT by only 1%, and therefore they do not expect a meaningful impact on the company's share price. So largely the important takeaway is that it is a much higher impact for BSE as compared to MCX.
All right, thanks a lot for that. We have about 2 minutes left for the markets to open. I just want to take a look at some more stocks. As we were telling you, some of these IT names are definitely in focus, right? By the way, IRDA is also up quite a bit. IRDA is up almost about 9% and big volumes picking up on IRDA this morning. Just pull up that chart at the moment. Okay, I think IRDA is, I don't know, it's showing me about a 9% move. Okay, there you have it, 9.5% higher. It's been granted the Navratna status from the Department of Public Enterprises. So there's some traction over there. Yes Bank is the other one, right? Looking pretty good. It's lower provisioning and tax write-backs that has aided the profits for Yes Bank this time. Profits coming in at 450 crores. So that's another stock that the street likes. And a couple of other names. Utkarsh Small Finance Bank is up almost about 3.5%. There's an improvement in asset quality for Utkarsh Small Finance Bank. Gross NPAs at 2.5% versus 3.04%. So looking pretty good over there.
Oh yeah, looking pretty good, and it's going to be a good start, right? 22,475 on the Nifty if you get that, and then we'll take it from there. Look at the BSE stock, and that's a large cut coming through. I mean, the pre-open discovered price is 15% lower, and it's we'll begin there. I mean, a 15% cut on a large liquid name like BSE after, of course, the very strong performance that we've seen on that one. MCX, of course, lesser degree impact, as Vamakshi was telling us. We've got the first rates coming up on our screens. You've got 22,490, 22,500 nearly. Sensex at about 73,940. So these are the very first rates. 60 points is what the Nifty is up by. Bank Nifty is up about 0.4%. You've got the mid-cap index, which is just marginally higher, nothing much at all. And you've got the small-cap index, which is starting, I think, a little higher as well, but not by very much. So it's a good start, about 22, just under 22,500 is what we have right now. So that's a start, but lots and lots and lots of stocks, and let's get this rolling. Sonia has got those. Sonia.
Oh, absolutely. There's so much to talk about this morning, right? So I want to start with the large caps. There's ICICI Bank that is pretty much topping the charts at the moment, up almost 0.6%. Good set of numbers. The earnings beat street estimates. Healthy deposit growth of 20%, loan growth of 16%. So that's one stock that's looking pretty good. On the flip side, though, you'd want to watch out for HCL Tech. Look at that. Almost a 4% knockdown is what HCL Tech is seeing this morning, and that's largely because of the guidance that was cut by the company, right? This time a guidance of just 3 to 5% versus CNBC-TV18's poll of 5 to 7%. So the street not liking that. The next stock I'm looking at is Maruti. It's up about 0.6%. As we were saying, although the margins are below street estimates, we won't be surprised to see the dips getting bought because largely the overall trend is still positive in terms of earnings. But this time around, there were some one-offs. The gross margins were under pressure as well. So that was a little bit of a disappointment over there. Shriram Finance, that one, the net interest margins are at a 2-year high. So Shriram Finance is the next stock that I'm looking at this morning. It'll come up for you on your screen in just a bit. 2% higher on that stock. Volumes are also picking up. L&T Finance is the other one. The disbursement growth has been pretty healthy for L&T Finance, so that one should also come up in a bit for you. 1% higher now, tracking higher both on volume and on price action. Now, Tech Mahindra, you just saw that stock 3.5% higher. There's a big, or 2.5% higher rather. There's a big double upgrade coming in from Morgan Stanley. They've upgraded it to an overweight. They have a target price of 14.90, which is a big upside to the current market price. Remember, this is a stock that rallied substantially last week as well. So, onwards and upwards for Tech Mahindra this morning. Apart from that, SBI Card, the revolver rate has improved for the first time in 8 quarters, but there are some misses in the numbers as well. So SBI Card is now down about 2.5%. Interglobe Aviation is another one I'm looking at. Nimesh was just telling us a while back that Morgan Stanley has raised their target price on Interglobe Aviation to 46.15, which is well above the current market price, and that's something that the street definitely likes. Now, we have a lot of earnings this week as well. You have Exide, Siad, Dabur that will all be coming out with their earnings. But the stock of the moment undoubtedly is BSE. Just look at the crack on BSE this morning. It's a 17% fall that we're seeing on BSE. It's the biggest single day drop since listing of the stock, and definitely not going down well with the street. So that is the big accident of the day, BSE. But apart from that, it's really not a bad opening for the market. The Nifty now up almost 65 points. Back to you guys.
All right. Thanks a lot for that, Sonia. Well, Apollo Hospitals, they've announced a long-awaited deal. The street has found it too complex, and I think the promoter entity getting merged into this set of business, I think the street doesn't like that at all. And also the guidance that they've given, the street is doubting that, in terms of how this merged entity will scale up. We'll have the management who will clarify all of that and more. But for the time being, the stock is down 4.5%. The other two stocks that are highlighted earlier today, one is BSE on the downside because of the regulatory changes, and they'll have to pay more. So, post the direction coming in from SEBI. So that stock is down 17%. It's the biggest loser in terms of volumes as well. One of the biggest gainers, though, from the FNO pack is AU Small Finance Bank. The rules that are coming out and the guidelines that are giving in from RBI, they've perfectly fit the bill with regard to transforming or moving from a small finance bank to a universal bank, and that's why that stock for the time being is up 3%. Keep in mind that it won't happen very, very quickly, but at least they're ticking all the boxes out there. So that one, in fact, is up and about. IDFC First Bank, Abhishek told us those numbers weren't great. So that explains why that stock is down close to around 4%, approximately 3.5% now. We'll have the management in a short while from now. SBI Life, those numbers look quite good, and that stock, in fact, is one of the big gainers actually on the Nifty itself in today's trading session, up 2.5%. Metal stocks, well, some of them, they're opened up in the green. You had Vedanta that was trading in the green. For the time being, it's still up close to around 1%. And you have Hindustan Copper as well, up close to 1%. So a decent start, Prashant, to kickstart trade. Just throw in there one more stock, Craftsman Auto. The stock is down 5%. I think it came out with a set of numbers. That one is taking it on the chin as we speak, down 5%. Prashant.
All right. So that's a good start, right? 70 points higher, 22,500 is where we are at right now. Just a few other names, right? So you've got Yes Bank top of the list, the biggest volume-led gainer, of course, 6.5 higher. But look at IRNA, 8% higher, huge volumes. Hudco, Nimesh had that stock on his chatter list on Friday, or was it Thursday, but 5% again. Hudco had a 10% plus move that day. Ircon is up 5.5%. So these PSU names are coming up with some gusto. Supreme Industries reported numbers, and Supreme is up a big 7%. I mean, huge volumes for this point in the day on Supreme Industries. Transformers and rectifiers is back to winning ways. It's up 5%, 660 on that one. New India Assurance is coming up with huge volumes, 5.5 higher on New India Assurance. Jaiprakash Associates, I'm not sure if there's any news, but 6%, and it's got volumes to back it this morning. There is Techno Electric. Techno Electric has done very well last 1 week, you know, from I think 900 kind of levels, actually 800 levels 2 weeks back. It's at about 1,000 rupees plus. So that is Techno Electric for you. We've got IIFL Securities, which is up 6%. I can go down the list, but volumes will then start to fade a little bit. But that's essentially the bulk of what is moving up with large volumes. MCX started with a small cut, but I think MCX also is starting to sell off a little bit more. So that is down about 2% plus right now. That's a 100 rupee cut coming through there. So that is the overall picture. Has SBI Card moved down, or is it something with my price? If you can just...
It's still up about 2.5%.
Okay, it's still up.
2.5%.
Okay, all right. So 7... SBI Card will come. It's down.
It's down. SBI is
it's moved
because of the
down.
credit
Okay,
cost
yeah.
staying elevated at 7%.
It's down 2%. So it's a big sort of move from the highs of the day for SBI Card. The high was about 743. And it's lost about 10, 12 bucks from there.
I just want to mention one thing on BSE, right? That stock is now down almost 20%, so don't lose sight of that. Jefferies put out a note where they've downgraded the stock, and they said that the higher fees, because of the, the company has been asked to pay its regulatory fees to SEBI, that higher fees could hit the overall EPS by 15 to 18%. So that's the kind of cut that we are expecting to see on BSE. But Mihir Vora is joining in as a Chief Investment Officer at Trust Mutual Fund. Mihir, hi, good morning, and thanks for joining in on the show. You know, this is a market that's very interesting, right? I mean, on one hand, we are making new highs, but on the other hand, there are also a lot of concerns that this market has. What happens post-elections? There are a lot of geopolitical concerns. Crude has been moving higher, etc., etc. So how do you deal with all of this in a market that's hitting new highs every day? Continue to stay invested?
Good morning, Sonia. Always a pleasure to be on the show. Yes, because there is ample scope for stock picking. We are taking the view that the Indian economy will not be that correlated to the global economy because, initially, as we know, we didn't do that kind of a stimulus during COVID times. And so the withdrawal of stimulus is also not going to be that sharp for us. So I think relatively, India is in a good spot. We are hoping that the themes that we talked about, which is the domestic economy, including consumption, physical asset creation, will continue to do well over the next few years. And as we talk about the sub themes, I think there is enough excitement in the stock picking space.
Mir, hi, morning, and let me at the outside congratulate you. 500 crores in assets and tens of thousands of investors. So congratulations to you and the trust team. Hope to see a few zeros, added to that number as
Certainly.
we go along.
Thank you so much.
Mir, talk to us a little bit about, you saw the action on BSE. I know you can't talk about specific stocks, right? But this regulatory fee action, does it raise some amount of regulatory risk for these capital market plays? And a lot of this, of course, is on the option side, where the regulator has expressed discomfort earlier on as well. So you don't know how exactly, or rather where exactly the action comes from, or do you think this is okay, and interest and momentum is strong enough that even if exchanges have to increase prices, it's a strong market and earnings trajectory will remain pretty good?
I don't think there's any extra regulatory action which has happened. It's more of a question of interpretation or accounting treatment. So I don't think this warrants any, concern as far as regulatory scrutiny or overbearance is concerned. I think it was more of a company-specific issue rather than a general issue, I say.
Hi, Mir, and congratulations from my end as well to you as well as your team. I think 16,000 investors, 500 crores mobilized. Best wishes to you and team. Well, the big event that we're looking forward to on the domestic front is elections. And some part of the street is in that vicinity of expectations of, say, 350, 330 odd. What if the current ruling NDA, they get, majority, a comfortable majority, but they don't get those numbers that are talked about, the 350 odd? Will it be a cause for worry, or will you be happy? A majority is good enough, 300 odd, that's the ballpark number. thumbs up, and life continues.
I think the market is factoring in a majority for sure. And so that means a continuity of the policies and the regime. Now, whether it's a super majority or a minor majority, I think that may create some volatility in the immediate few days after the results. But as long as the markets see policy continuity, I think we should be okay. Nothing much to read there, frankly.
How did you read the IT numbers? Because, it's a mixed bag, right? On one hand, Tech Mahindra did quite well. On the other hand, players like HCL Tech not looking good in terms of guidance. Infosys was not too great either. So what do investors do now in this big tech space?
See, IT, the large companies are facing headwinds for sure. That's been our call for quite some time. We do believe that the bunched up spending that happened post-COVID because of a lot of factors, people working from home, lots more online activity, lots more trading activities, etc. I think that extra spending in the 2 years after COVID, I think we are past that. Of course, there is some bump up and some more action in the AI space, but I don't think Indian companies are participating in that in a big way. So I think IT, the large companies are most likely back to their pre-COVID growth rates, which was more like single-digit growth rates, and that's where we are going to. There are few mid-cap companies which are following specific business models, specific verticals, which can grow faster than the rest of the IT pack. So we should go for stock selective measures rather than a broad call on IT. In general, I think the large IT companies are likely to grow slower than the rest of the market, which is more domestic linked.
When we spoke around the time of the launch of the fund, you guys were talking about that, finding big gorilla ideas, right? So without naming these gorillas, if you can talk to us about how that composition, I mean, you're already investing money, you're putting that to work. Where is it going? Which are the big ideas, themes rather, that you're bidding on in the fund?
Sure. I think at the time of the NFO, it looked like we'll probably be a little more mid and small cap bias compared to the benchmark. It's going, I think, in that direction, it looks like, for sure. And the themes, we will continue with the three themes that we talked about, basically, which is, premium consumption and financialization of savings. So in premium consumption, we have a lot of services and products, of course, and consumer items, especially the high-end consumer discretionary spending, both in services and goods. Then financialization also includes, a lot of capital market linked segments, wealth management, broking, asset management, insurance, a lot of the segments which cater to large scale savings. Second is physical asset creation, which includes infrastructure, real estate, as well as manufacturing themes. And the third is technological disruption with all these new business models coming in, disruptive business models coming in. So I think we will stick to those themes that we identified, and the portfolio is likely to, probably be a little more biased toward mid and small.
Okay, all right. We leave it at that, Mihir. Thanks a lot for joining in. You were talking about how large cap IT companies are facing headwinds, right? So we do have the management of HCL Tech, who's joining us now. So would invite you to listen in as well. HCL Tech is down in trade on the back of a disappointing set of Q4 numbers. Their revenues came in line with street estimates, but it's the margins that have contracted. The company's growth outlook of 3 to 5% for FY25 has also come in below expectations. To discuss more on the Q4 performance, my colleague Rima caught up with the management, began by asking him about FY25 guidance and how they'll manage to meet their growth targets. Listen in.
What we have assumed is the external environment and the amount of discretionary runoff that happened in FY24, we've assumed exactly the same numbers for this year. And 3 to 5 is our guidance. And if you look at the every year, there are a lot that can happen during the year. And I think more important than the guidance, I think what's very relevant, Rima, is in FY23, we had the highest growth in services. We had the growth leadership in the industry. 24, we maintained the growth leadership. And I'm pretty confident that we will maintain the growth leadership in a handsome way this year as well. This is based on what we're seeing in the market, based on the deals that we're participating, the pipeline that we have. However, it's important to remain cognizant of the fact that there is some discretionary runoff that happened all through FY24. And we've made the same assumption. And it's a mathematical calculation which leads us to 3 to 5% guidance.
Okay. You've also said that there's a 2% negative impact in Q1, or Q1 revenues will be down 2% because of one large project which is getting offshored now. And in Q2, there will be an 80 basis points impact due to the State Street JV exit. So will Q2 also have a negative growth, and will the company bounce back to growth only in Q3 and Q4?
Actually, Rima, there's just a lot of optics, right? I mean, if you take Q1 at a 2% decline, HCL Tech will still be the fastest growing company year on year. It'll be probably upwards of 5.6, 5.7%, which is even higher than our guided range. And even if I assume a 1% growth, we will again be a pretty handsome growth, which exceeds our guided range. So actually, our H1, technically from a year-on-year perspective, will be a strong first half. So I think HCL Tech cannot be compared on a QOQ because 3 out of the 4 quarters, there is seasonality in the business. Either in December, we have a peak, and then there is a softness in JFM quarter in the software business. And Q1 is soft because of a year-on-year contract productivity that kicks in. So the right way to look at our numbers is year-on-year. And maybe if you really needed to compare, then that should be the comparison.
Okay, but just in Q2, will it be growth or will it be a decline in your top line, CVK?
Right. See, we've done $2.3 billion of booking this quarter, a bulk of which will translate into revenue in Q2. And we remain confident of growth in Q2 and the subsequent quarters, which should nicely help us deliver the market leadership on the growth.
Prateek, your margin guidance stands at 18 to 19%. Can you explain the math behind that? And your aspiration is to grow margins to 19 to 20%. When do you get to that?
Yeah, Rima, thanks. I think, last 2 years, if you see FY23 as well as FY24, we have given the guidance of 18 to 19%. And we've delivered exactly the same number, 18.2% in both those years. So given the environment that we are currently going through, I think that's the right range for this period. The aspirational range of 19 to 20% that we have talked about is a little pushed out right now. But our efforts are always to sort of get back to that pre-COVID kind of a range that we talked about. So right now, I wouldn't take a sort of punt on when we will be able to come to that. But for now, for this year, which has just started, we are sticking to 18 to 19%.
Okay. And just, Prateek, if you could weigh in on the deal wins and the pipeline. Can you give us the mix between large, small, mid-size? Because we had Emphasis last week, and they spoke about how short burst deals of a smaller size between $0 to $10 million are picking up, and that's the highest that they've seen in the last many quarters. So explain the deal pipeline to us.
Yeah, so like I think CVK referred to it already, I'll probably expand a little bit on that. See, the thing is, in any quarter, in any fiscal year as well, there is a substantial part that, is comprised of the small deals, 0 to 10 million, like you mentioned. And not only that, but during the year, there are several deals which come into the pipeline, get booked, and then the revenue gets delivered as well. So that is the nature of our business. I'm sure that's what Emphasis talked about as well. And we remain focused on all sizes of deals because at the end of the day, we have to really, the momentum and the velocity of those deals really determines our growth. As of now, going into the new year, we have not assumed any optimism that the environment will get better. We have assumed that it will remain the same as what it has been for the last 4 quarters. And with that, and given all the calculations and estimates and assumptions, we came to 3 to 5%. It is a little soft. I mean, most people were expecting 4 to 6 or something like that. It is about 1 percentage point lower than that. It's not a mile off.
Okay, fair enough. CVK also talked to us about the annual productivity benefits that you're passing on to the clients. Is that more than normal this time? And two, in your guidance, if you could talk about which geographies, which verticals will do well for you and which might be a drag.
So first, maybe let me take the geographies and verticals. I mean, if you see our financial services delivered 12% growth when across the industry, most people declined. I think a lot of this is to do with the big bets that we took, whether it is insurance, wealth management, or the hybrid cloud adoption in some of the large financial services firms. I think that momentum will continue, but of course, we are coming off a very high base. So to that extent, the financial services will be modest. But tech is going to rebound. I mean, we already have enough pipeline. We think tech will do well. Telecom will continue to do well. In addition to the large deal, we have a number of programs in telecom service provider segment that's going to help us. Retail CPG will do well, and manufacturing and life sciences, I think it'll maybe it will do well in the second half. That's really the kind of vertical split. But if you take the geography, US continues to be a very strong geography for us. Even in FY24, when there was a lot of stress in the environment, we grew 6.8% in the US. Europe will be a little soft, and that's broadly how I see the environment going forward.
And the annual productivity benefits that you pass on to the clients, is it more than normal this time?
Actually, it's in some cases it's a little more because the automation expectation is generally higher. While most of this, what we're talking about are productivity which is already in the contract and where we have assumed certain level of automation will come in as we continue to execute some of the run the business kind of programs. When there is a new deal that's renewal, in fact, even last quarter we did more than $2.5 billion of renewals. And in the renewals, of course, there is a lot of emphasis on factoring in the productivity of GenAI. But again, when we say productivity of GenAI, customers are also looking at greater volume getting delivered for same. In fact, I talked about doing more with less. That's really what the theme is. But doing more, while it is some form of a commitment from the customers, but it will only happen over a period of time. I mean, it does not come on day one. So every renewal, we end up getting commitments for significant additional business. It's more than offsets the productivity lever that we pass on to the clients.
Okay, that's the word coming in from HCL Tech. Let's do one thing. Let's take a quick break. When we come back, we'll be joined by Amit Kumar Sinha, the MD and CEO of Mahindra Lifespace, to discuss their fourth quarter earnings.
Co-presented by
Welcome back. Well, Mahindra Lifespace is on our radar now. The company reported a strong operational performance in Q4. Their bookings and volumes are at a multi-quarter high. Collections have also surged 35%. To discuss more on this and the Q4 performance, Amit Kumar Sinha, the MD and CEO of Mahindra Lifespaces, is with us. Amit, hi, good morning, and thanks a lot for joining in. Very strong operational performance in terms of booking. So can you tell us what has led to this? How is the demand situation right now? And what is the quarterly run rate that you're looking at? In Q4, it's gone to above 1,000 crores in terms of bookings. What do you think you can do as a sustainable rate in FY25?
Thank you for having me. Absolutely delighted to share the results. It's been one of our best quarter, as you noted. Great on the pre-sale side. And I think, as you may know, we had a great launch, Mahindra Vista, in Kandivali, which was practically sold out within days. So quarter four demonstrates the buoyancy that we see in the market, especially in Mumbai, Pune, and Bangalore, where we are operating. we expect the momentum to continue. To your question about how's the market, we see a strong, healthy demand. The absorption is very healthy in Mumbai. It's very healthy in Pune, and in Bangalore also. We launched one each project in Pune and Bangalore in the last 6 to 8 weeks. Again, 70 to 80% sellout in one weekend, both the projects. We're seeing great momentum all across the market that we are participating. For F25, we had given a guidance of 2,500 crore, but given the momentum, we hope to surpass that. It's a lumpy business. There are cycles related to land acquisition. The land to launch timeline could vary based on approvals, but we are confident that we'll be beating our target that we had publicly announced last time around, which is 2,500 crore pre-sales for F25.
Okay, that's great to hear. So you're saying that you will exceed the 25, you hope to exceed the 2,500 crore target in terms of sales for FY25. Got that. You have a development pipeline of a little over 37 million square feet. How much of that is completed? How much is under construction? And, if you can just break it up for us, where are you veering towards? Is it more towards premium or is it towards affordable?
Yeah, so I will just keep it simple. Just from a million square foot gets sometimes confusing, but historically we have played a big role in affordable. But over the last 2 years, and especially after I came on board last year, we have focusing a lot more on premium in line with our brand promise, brand expectation, and the target customer segments. And the reason it makes sense is because the per capita income is going up, the land prices are going up. It just makes sense for us to create dream homes which matches our target segment. So we will continue to look at affordable, the commitment we have made, the projects are already going, and we'll be looking at those projects as and when they come along. But our focus will shift from affordable to mid-premium to ideally more and more premium. In terms of where the value will come future, in terms of million square foot, I would give you a better indication in terms of the value of the project, the sales value. I'll put 80% of our future projects will be premium, at least in the next 3 years, and 20% would be affordable, which we have already committed to.
Okay, all right. Hi, Amit. Good morning and good to see you in. Nigel on this side. You've been increasingly sounding very, very optimistic about the sales numbers. So I guess operationally you got things in order. But let's focus a little bit on the balance sheet. Your debt is not too high. Net debt, I think, is around 550 crores odd. But since you've got such a big pipeline that's planned out, what will this debt number look like? That's point number one. And I think you had a 50-acre land in Chennai that you had planned to sell. When does that take place?
So let me start with the second one. We have a huge land parcel as part of Mahindra World City, Chennai. And the one part is industrial, the other is residential. The industrial business model is we do the master development, which we have done in Mahindra World City, Chennai, as well as North Chennai, which is Origin Chennai. And our business is to attract, let's say, global MNCs who are looking for manufacturing facilities, which are kind of plug and play industrial park. So we're always selling land as part of it. The 50 acre that you might be referring to is the residential part of the World Cities as well as Origins. The way we are thinking about, instead of selling those land pieces, we are doing plotted development. We have done 2 in the last 12 months. And we're also looking for additional high rises where the economics make sense. We are not trying to sell those pieces to third party or any other developer. So that's on the Chennai question. On the balance sheet, I think you're right. We are very thoughtful about our debt to equity ratios. So I think our goal is to be as conservative as we can be. But for growth, you need capital. And given Mahindra Lifespace has been designated as a growth gem at Mahindra corporate level, Mahindra group level, we expect the support in the form of equity or even debt to come from the group. Ideally equity, because it aligns very well the nature of this industry. We've just started the discussion on raising a platform that could be with support from, let's say, external fund providers. And those discussions just started. The first year for me was to get our house in order, clarify the strategy, demonstrate how we can operationally show strong wins in the early stages, and then raise the nature of the industry.
So, sorry, what is this platform for, Amit? Morning. This platform that is in the early...
Yeah, the platform, we have done a couple of them already. We have done one with Actors, we have done with HDFC Capital in the past. So this platform is for residential projects. Residential projects have a upfront equity requirement because you're trying to buy land parcel. So this is for that. It's just, the efforts have just started, but we are thinking bigger in terms of how we get equity in the company to support our aspirations.
Sure. This is beyond that 50 acres in Chennai that you spoke about, right?
It's very different from Chennai. Yeah, it's very different from Chennai.
All right, fair enough. Any new sort of redevelopment projects in Mumbai in the pipeline, which we will hear about?
So there is a lot in the pipeline, but we have a very high guardrail for saying yes and no to these projects. So we are, I think, 2 in the pipeline that we are close to finalizing. Finalizing meaning the societies are in the process of finalizing. We are anxiously and putting our best foot forward. Let's hope they happen. But our goal right now, we want 2 in the last financial year or just around that time. Our goal is to bring them to market at the earliest now.
Okay. All right. Amit, we'll leave it there. Good luck. Thank you very much for your time. Appreciate you joining in with some of that perspective on CNBC TV18. So pre-sales should be over 2,500 crores, as you said, for FY25, and this is better than what they'd said earlier. Let's focus back on BSE and MCX. BSE, of course, has taken a bit of a dive. Vamakshi is here with a spotlight on these names again. Vamakshi.
Well, absolutely, both of these counters are reeling under pressure. The news flow is that the companies have been asked to pay regulatory fees to SEBI based on annual turnover calculated from the notional value of option contracts, the key word here being notional. And that is because the companies earlier were calculating the annual turnover based on the premium value for the options contracts, which is much lower than the notional value. The companies have been asked to pay the differential regulatory fee for the past period along with interest. So therefore, the amount that BSE has to pay is roughly around 165 crores, while that for MCX is around 4.5 crores. Largely, Jefferies believes that the higher fees could impact BSE's EPS by almost 15 to 18%. They've gone ahead and cut their FY25 and 26 estimates by nearly 6 to 9%, leading to a lower target price of 2,900 per share. And they've gone ahead and downgraded this the rating on the stock from buy to hold. As far as MCX is concerned, Morgan Stanley believes that the differential fees could be expected at around 4 crores, which is only 1% of the company's FY25 PBT estimate, and therefore they do not expect to see a meaningful impact on the company. So therefore, largely the takeaway is that the impact for BSE is expected to be much higher as compared to MCX, but nevertheless, both of these counters reeling under pressure today.
Okay, all right, Vamakshi, thanks a lot for that. Well, the markets are holding steady, but we've come off the high point of the day. The Nifty Bank is outperforming as we speak. And talking about the banking names, well, let's talk about IDFC First Bank. Mr. Vaidyanathan, the managing director as well as the CEO of the bank, joins us on the show. Hi, Mr. Vaidyanathan. Good morning, and thanks a lot for joining in. Well, the stock price reaction tells you that the street wasn't really impressed with the past quarter's numbers, or maybe they're a little bit skittish on the guidance that's given. So good to have you to clarify all of that. Now, you've guided for higher credit cost, at least in the first half of the fiscal. Why have you guided for higher credit costs in the near future? What kind of stress do you foresee? Please go ahead.
So before we come to your specific question, let me refer to your first point. You said markets didn't react well. See, the thing is that the newspaper reports came out that net profit for the quarter is down 10% over the last year. I just want to clarify that last year when we reported a profit of 801 crore, we clearly pointed out that we had a one-time treasury gain, by some off-market transactions, which gave us that kind of profit. The true profit was 700 crore. So against that, actually, PAT has gone up in a like-to-like basis. And a year-on-year basis, our PAT is up 24%. If you take out the treasury income, which we really don't in a bank upon, and nobody can ever bank upon, our PAT is up 28% over last year. So I think this one clarity I wanted to leave out to you. Now back to your second question on the
credit cost.
Question.
What is the credit cost, sir? The credit cost is likely to remain elevated in the first half of the fiscal. Why? What kind of stress are you seeing? Please go ahead, sir.
Yes. First of all, we're seeing no stress. Let me put it plain and simple. Our gross NPA on the bank level running at 1.88, which is the lowest ever in the history. Our net NPA is some 0.6%, also quite lowest in the history. And our SMA, which is the pipeline leading to the NPA, SMA is the pre-NPA stage, the 0 to 90 DPD. That is also very low at some point. SMA 1 and 2 is just 0.85%. So let me just say there's no stress at all. Now, with regard to credit cost. Now, with credit cost, we are running a credit cost of less than 1% on a percentage of average assets. Less than 1%. It's already quite low. And for the next year also, we have guided for, but percentage of the loans outstanding was 1.32% this year. We're guiding for 1.6% next year because we're expecting normalization. Until last year, we were getting recoveries from COVID. We are now guiding for normalization, but even 1.6 is pretty good for the bank. It's come down from the past. So there's no stress. And let me just tell you, this is factored in the way we plan our model. And 1.6 is, you can check the industry, it's considered really quite good.
Okay. Mr. Vedanthan, hi, morning. So is this sort of some calibration on growth that we should expect in FY25? Is that where this is coming from?
No, basically, see, how do you get loan growth? You get it from deposit growth. So from the deposit growth front, our bank grew deposit 40% last year, which I hope you'll agree is really something. On a large base that we already have. Next year, we are planning to grow deposit by 30%, which is needed for us because we need to grow our loan book and also need to repay some legacy liabilities. So we could plan to grow by 30%, and accordingly, we'll grow the loan book. So we always will want to grow our loan book lesser than a deposit growth because we want to improve our credit deposit ratio. And frankly, it's working well to plan.
Okay. So what is that number then? What do you expect it to grow by? I think FY24 advances growth was about 28%.
No, it is around, if you take assets, percentage of assets like 23%, and take a percentage of loans is 25% currently in the year of 24. And this year, we expect to slow down a bit. Let me just say like maybe 22% or 23%. But we'll grow deposit by 30. And when we grow this by 22 and grow that by 30, our credit deposit ratio will come down. Our incremental CD ratio, we want to keep it at 80%, not more than that. And we want to do our credit deposit ratio, which was 140% 4 years ago. This year we brought it down to below 100, which we're very happy about. And by this year, we'll bring it down to 92%. So it's all looking good.
Okay. I wanted to understand a little bit about the cost to income ratio. With that declining, what is the medium-term target that you have for the cost to income ratio? It was elevated at more than 72% in Q4 of this year. So going ahead, what can we expect?
First of all, you should see it in context, because like I said, in the last few years, we have set up, we grew branches from 200 to 900. ATMs grew from 150 to 1100. We launched so many businesses for doing rural banking because we were short on PSL sector. So we had to do a lot of investments to set the basic foundation right. The good news is that those will start paying back. One of the investments is credit card business. So good news that all start paying back. We feel that it has come down from 95 to 72. It's good progression. This year, our credit cost income ratio did not improve. I admit that it did not improve because interest rates went up and a few things happened. But next year, by Q4 FY25, we expect credit costs also to come down for the first time in our history to the 60s. So it will happen. As businesses scale up and start throwing profit, the cost to cost income ratio will come down.
So which is the segment going forward which will sort of drive credit costs, which will also drive loan growth over the next, say, 1 to 2 years?
Credit costs, I told you, we are expecting a very good behavior of the bank. So really, there's no issue at all. This is our biggest badge of honor. For 14 years, our credit costs have never been troubled us. With regard to you said credit costs, you said one more question after that?
Loan growth, which is the segment that will drive loan growth going forward?
Yes. So we want to, currently on the unsecured retail side, our loan book is about 15% and of the total book of the bank. And we want to grow the secured book more than that. And therefore, our areas of growth will be gold loans, going to be a big area. Right now, 1,000 crores. Planning end of this year, we're planning that book to be 3,000 crores. We want to grow the home loan book. That we expect to grow well. We expect to grow loan against property. We want to launch tractor loans because we want to do the priority sector, agri priority sector. So these are some focus areas for the bank.
All right, Mr. Vaidyanathan, two-part question then. The cost-to-income ratio, that's a little bit elevated, but you have mentioned in the past that you can see that, plateauing out in the times to come. I'm looking at your OPEX as a percentage of assets. I think that as well has moved up on a sequential basis. So give us a couple of numbers then. Cost-to-income ratio from around 72%, what does it come down to? Point number one. And the ROA in the past, you've told us as well, say by 2029, you see that number at around 1.9 to around 2%. If you could tell us in the near term.
Nigel, one question at a time, so it makes life easier. So
let's focus on the cost-to-income ratio first up.
Exactly. Yeah, it just makes I don't have to load any questions on my head.
Sure.
So the cost-income ratio right now like 72%. End of this year, we can expect it to come to the 60s. Q1, Q2 will probably be in the same zone. Because there is some front loading of expenses happening because we're migrating from a FLDG structure from a non-FLDG structure and digital partners to FLDG structure. So without taking into technicalities, Q3, Q4, let me say is that we expect the cost-income ratio to meaningfully come down, and we will celebrate when it comes to 60s because most people believe that our needle is stuck in the 70s. I'll show to all of you it will come to the 60s.
So by the end of this year, what does it come down to? By the quarter four, when we chat a year later, it'll come down to 60s, but you want to give us a number or a small range?
Yeah, I told you. Let me say the 60s, to get in the 60s barrier is a big moment, but it'll definitely happen because that's how the business is built actually. To give you one example, I'll give you an example. It'll drive home the point. Let's take credit cards. We launched credit cards 4 years ago. Last year, credit card cost-to-income ratio was some 212%. Then last year it came down to 160%. This year it's still high. It is above something like 115, 116%, maybe 120%. Next year we expect it to come below 100% by end of this year. So every business, when you scale up, first you all run businesses. First you incur the cost. People come in, there's structure, there's technology costs, everything comes first. Then the business builds, cost come down.
Okay. By the way, Mr. Vaidyanathan, will there be a capital raise this year?
Yes, we are planning one capital raise this year. Yes. We think that
quantum,
anyway,
by when?
we probably, let me just say that sometime during the course of the year. And it's also good because we're already running capital adequacy of 16%, as you know. We've just taken a 5,000 crore bond approval from the board just now. That will raise sometime in the course of the year. That also will, shore up capital. That's Tier 2 bonds. We'll also probably raise another round of capital this year. That will also strengthen the balance sheet. Unfortunately, since the price to book is still substantially above the book value, it will be adding value to shareholders because book value per share will go up if we raise capital at these prices.
Okay, Mr. Vaidyanathan, good chat as always. Thank you very much, and hope to speak with you mid-quarter to get a sense of how this one is going. Appreciate it, you joining us. Well, Apollo HealthCo is a subsidiary of Apollo Hospitals, and it has entered into an agreement with global private equity firm Advent International to raise 2,475 crores. As per the agreement, Apollo HealthCo would integrate 100% of its wholesale pharmaceuticals distributor firm, KeyMed, with Advent International over the next 24 to 30 months. To discuss more on this, we have Ms. Sunita Reddy, Managing Director at Apollo Hospitals, joining in. Ma'am, good morning. Great to have you with us here. Prashant this side. First up, I should say congratulations. I mean, I think we've been asking you when is something going to happen for a while, and this is now finally gone through. I just want to start by asking you, was there? Just give us some are pointing out that the valuation at which this has been done and what this values Apollo HealthCo at is about 20-25% lower than what they were kind of penciling in. So just wanted you to address that to begin this conversation.
I don't believe it is 20-25% lower. Yes, maybe 20% lower than what the market was expecting. But the most important thing to realize right now is at this market, at this time, I think timeliness is crucial. We now will have a very strong balance sheet, which will enable the growth of Apollo HealthCo. And if you look at the entire transaction, it will create India's largest omni-channel pharmacy play. Added to that, of course, is the benefits that will now come from the digital network that we have created, which has multiple revenue streams. So we are enabling growth, we are funding growth, and we have a strong balance sheet. It could be at a 20% discount to market expectations, but I think having cash in hand and a strong balance sheet far outweighs that.
And what kind of drove the next step, which is the merger of KeyMed, the promoter family's pharma distribution arm, into the fold, and how was valuation there derived? I mean, did you sort of go by some of the last rounds which happened there in that company?
So there were three aspects of the valuation. The first, of course, is that we had Apollo Hospitals had KPMG and EY do a valuation. And of course, we had Deloitte do a deep due diligence on KeyMed. And therefore, the value was arrived, which Advent actually accepted this value based on these valuations. So we did get a third-party validation of the value. Having said that, KeyMed does have other investors along with the Reddy family. So we really had to amalgamate all the investors into this transaction. So that was important in the way that we dealt with the valuation.
Okay, I'll come back to the valuations in a bit, Ms. Reddy. But the other thing also that the street is a bit concerned about is the margins, right, at which KeyMed is working at, about 3.5% or so, and what this would do to the blended business as well. Is there any scope for margin improvement, operational improvement over the next, 1 to 2 years? And can you just throw some light on that?
Yes, current margins are at 3%. But I think as we go forward, we have to look at the scale of KeyMed and the fact that it supplies to 70,000 pharmacies. We believe that private label is the right way forward. So if you look at, combination of both what we're doing, AHL offline and KeyMed, we're able to deliver a 10.7% margin, moving into 11%. And that with the significant scale is actually a good number.
So can you tell us, so you said 10.7 to 11% is what you're looking at by when?
By 2027.
Okay, by 2027, got it. And can you tell us what the other synergies are post this deal that will come through with the company?
Yes, I think the fact that, the KeyMed already has about 4,000 SKUs. They have 100 distribution centers. They are supplying to 70,000 pharmacies. So definitely, and AHL is present through its digital presence, through its existing network in 19,000 PIN codes. So I think it's really going to enable growth for Apollo Health Co.
Okay, all right. Hi, Ms. Reddy. Good morning and good to see you. When you've given a target of 25,000 crores in terms of revenues. That's a tall ask, right? Even from current levels, even if you're going to grow at a very, very fast clip. Are you factoring in some inorganic growth as well?
Yes, I think KeyMed is looking at some inorganic growth, and that will enable it to grow at around 20%.
Okay. So out of the total 25,000 crore mark that you're talking about, the current merged entity will be how much of that number? And the inorganic growth will contribute to how much of the 25,000 guidance that you've given by 2027?
Let's take a realistic figure. Right now we have around 22,470 crores planned for 2027. Out of that, I would say that around 11,000 crores will come from KeyMed, and the balance will come from Apollo Health Co.
Ma'am, for Apollo Hospitals, I mean, this particular transaction, what does it do? I mean, there are two parts actually. One, Advent, of course, has rather worked in the area of healthcare for globally. And it's a known player there. So what do they bring to the table in that sense? And second, once both these, the two-step process is complete, at the hospitals level, does this increase complexity in any way?
No, it does not increase complexity in any way. I think if you look at what it does for the business, we're moving from negative cash flows to hugely positive cash flows, and that's really important. The second is the fact that we're able to consolidate these cash flows and profits after the next 2 years, which is very good for the company. And third, it gives us access to the network that Apollo Healthco will create. So the revenue streams of Apollo Healthco, while offline pharmacy is the largest, the second that they're developing is, of course, the teleconsults that they're doing using the doctors, the connectivity with the diagnostics where the scale is improving dramatically. And of course, being the front face of Apollo, enabling customers to come into the Apollo system. I think the benefits of all that coming together holistically and delivering on very positive cash flows is really why it's hugely beneficial. I must say that while you're thinking of the valuation of these companies, Apollo Healthco has been valued at a 15% premium to existing peers. And KeyMed has been valued at a 20% discount to listed peers. So we believe that the valuation also is there.
Okay, I just had one clarification. When you said 10 to 11% margins earlier by FY27, that was for Apollo Hospitals or Apollo Healthco?
Apollo Healthco.
For Apollo Healthco, okay, because earlier I think your guidance was 7 to 8% margins, right? So is it fair to assume that you've scaled it up?
Yes, I think with the private label, we'll be able to scale it up, yes.
Okay, fair enough. And one more question on any listing plans that you would have for Healthco over the next year or so. I'm just asking because any plans that Advent would have to exit, because I think there is a listing period of 7 years or a mandated sale that you'd be looking at, right?
Yes, I think, there is an optionality. We could look at it closer to that time, but I think right now the focus is on growth and really on realizing that positive cash flow and profitability for the company, and also the restructuring and the steps that we need to follow, which is have an AGM, get CCI approval. So post that, we can think of, I think we have time to think about Advent's exit.
All right, Ms. Reddy, final question before we let you go. The 2,475 crore that's being received by Advent towards Class B preference shares, that breakup is sorted out, 1,732 and 743. But what is this 1,485 crores towards Class B preference shares? Could you explain this 1,485?
The 1,480, so the figures that we have discussed is 14,482 crores for Apollo Healthco, 8,003 crores for KeyMed. So this is the breakup. The first part of the transaction will be acquiring KeyMed in the first stage, 2% of KeyMed, which is the first stage. So that is the breakup and the process through which this will happen.
We are referring to the money that's coming in from Advent. The money that we have clarity on, that's there's no worries on that front. The 2,475. But in the release, you've mentioned another number, which is 1,485 crores. What is that? 1,485 crores?
That will go towards the acquisition of some of the KeyMed shareholders.
All right. Fair enough. We'll leave it there, ma'am. Thank you very much for joining us and running us through some of the details around these sort of two-leg transactions. Thanks once again. Stocks down about, 8% or so. The market, I mean, just to take a quick look, is still up about 65 points. 22,000, just under 22,500 is where we are at. We'll take a break. We are back. I think we'll just run through markets with Mitesh in just a bit. And then we'll have the management of Shriram Finance joining us as well. Stay tuned. Okay, welcome back. 60 points higher, 22,478 is where we're at. Mitesh is with us with, what to do now. Mitesh, morning again.
Yeah. Morning, Prashant. I think there's good action happening in the OMC stocks. So, have a look at IOC. I would recommend a buy here with a stop at about 173. Look for a target of 182 on the upside. And the other stock which I like is ICICI Bank. Of course, I think, numbers came and the stock started moving up. That's a buy with a stop at about 11.10 for targets of 11.75.
Okay, by the way, ICICI Bank is at a fresh 52-week high this morning. So post its numbers looking pretty solid there. 14% higher year on year for ICICI Bank this year rather. So good move there. Let's take a quick break. On the other side, we'll be joined by Umesh Revankar, who's the Executive Vice Chairman, Shriram Finance, to discuss their Q4 numbers. Stay tuned.
Welcome back. You got the market, which is doing well. We're up 60 points. 22,500 nearly is where we are holding. Market breadth also looking pretty good. Shriram Finance reported a good set of numbers for the fourth quarter. I mean, it's been quite a good year for a year as well, FY24. Net interest margins are at 2-year highs. Asset quality is improved. Disbursements are also looking very strong. Mr. Umesh Revankar is Executive Vice Chairman at the company. He's joining us to take some questions. Mr. Revankar, good morning. Great to have you with us here, sir. Prashant this side. I mean, you continue to deliver and the stock continues to deliver for investors. So, I mean, I guess it's a happy situation. We've wrapped up FY24 and it's been strong and we'll get into some of the details. But just at a headline level, will you be able to continue these growth rates into 25 as well? Or will we see a little bit of moderation? So AUM growth for the full year was about 21%. Let's start there. What should we expect in 25?
Yeah, good morning. I think we had given a guidance of 15% last year and we grew a little better because better economic condition. And also there was higher ticket size because the prices of each of the asset classes whom we are lending had gone up in the previous year. And that may not be the case this year. That's one thing. Therefore, the year-on-year increase may not be as high. Plus, the election being there for the first 2 months and economy is to some extent dependent on government capex and government machinery not being there will also have some slowdown impact in the first 2 months. So first quarter can be a little slower, then probably it will pick up. So overall, we would like to give guidance of 15 and probably if the economy is doing very strongly in the second half of the year, we should be able to grow a little better than that.
So 15% is your disbursement guidance, is it? For the full year, for FY25?
AUM growth, yeah.
Oh, your AUM growth, okay, all right. And can you tell us rural markets, how much of a recovery have you seen so far? At what stage of the rural segment recovery are we at? And, what's the outlook going forward?
See, overall, if you look at the rural economy, we were quite positively surprised because the rural economy is doing very well. Overall credit growth in the system itself was 20%. So we did had a good demand for tractors and especially for two-wheelers. So if you look at the two-wheeler demand and growth for us is around 30% year on year, especially in the rural market. When I say rural market, more on agricultural dependent economy like UP, Bihar, MP. We had an excellent demand coming from this side, both for tractors and two-wheelers. So we do expect the rural economy to continue to do well. And also this year, the monsoon prediction being normal or above normal, it will augur well for us in the rural area.
So when you talk about this AUM growth, which is the segment that you think can drive the AUM growth? Will it largely come from the two-wheeler segment, the rural focused areas? I mean, can you give us a segment-wise breakup?
The overall, the demand for passenger vehicle across rural and urban has been good. One is good demand from tourism, a good demand from a rural economy doing well. Road network, there is a good demand for across the rural market for both the two-wheeler plus the normal passenger vehicle. So the rural economy is driving the passenger vehicle demand. plus the tractor demand continues to remain reasonably strong. MSME is another one area where we have used the cross-selling part of it. In the sense, we had two different business entities in the past. One was vehicle financing focused, another one is non-vehicle, especially MSME focused. Now, since we have a combined branch network and integration has done well for our business, and we are able to reach out with the MSME loan to more geography, and therefore the MSME growth also has been good. So MSME and passenger vehicle, including two-wheeler, will drive the growth for the next full year.
Okay, all right. Hi, good morning, Mr. Revankar. So we've got a fair bit in terms of growth. Give us a few more numbers. The NIMs came in at the highest we've seen in multiple quarters. I think it's a 2-year high. So what's the outlook on the NIMs? And the ROAs as well are holding at around 3.1%. So that's an improvement on a year-on-year as well as on a sequential basis. What's the guidance out there?
Basically, we are able to hold on to NIM or grow the NIM mainly because of a mix. We were able to to sell the high-yielding product like the gold loan, two-wheeler, and MSME, which are a little higher yielding than the commercial vehicle loans. That gave us a better mix and a better net interest margin. And also, we have managed our liability side very well. Our incremental increase in cost of in the liability side has been much lower compared to any peers. So year on year, the overall liability cost has gone up by only 20 basis points, and which we were able to pass it on to the customers. So overall, I think good product mix and better management of the liability side, we were able to have a better margin, and that has reflected in our ROA also.
So what will the guidance be then, sir, on the ROA?
We should be able to maintain at this level, maybe around 5 to 10 basis point increase on ROA, plus because the OPEX improvement. And also, we would say that on the net interest margin, we would like to maintain the present level at around 9%.
Okay, 9 plus, just under 9.
Around 9, yeah, maybe around plus or minus 5.
Okay. On the personal loans front, you've seen you've obviously taken it down disbursements very, very sharply in the quarter, right? So that one should assume will remain the strategy in 25 as well. And just a quick word on commercial vehicles. I don't think we've touched upon that. That's of course the core book for you.
Yeah, on the personal loan, we have been very cautious. We have further strengthened our credit rule engine. In fact, we have been giving personal loan only to our existing customer. We had not been going to the market and acquiring new customer on either digital platform or directly. So it is mostly for the successful existing customer who have completed one of the vehicle loan, we were giving the personal loan. So that's one thing. On a commercial vehicle loan, we have grown 14.6 in the last year. I'm talking about only the goods carrying vehicle. And on passenger vehicle, we have grown 30%. So overall, commercial vehicle has been reasonably good growth for us. And we will continue to grow in that segment, steady growth. I expect around 12% growth on commercial vehicle, because in the first quarter this year, new vehicle sales have been flattish and have come down a little in a certain segment of the commercial vehicle. So we would like to give a guidance of 12%, because first quarter again commercial vehicle sales can be little down, mainly because of the election-related activities, and government spend on the infra could be little lower in the first quarter. So that being the case, we are a little cautious about the growth.
All right, we leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. We wrap up with Bazaar on that note, but we'll leave you with a big exclusive interview now. Prime Minister Narendra Modi sat down with the Network 18's Group Editor-in-Chief Rahul Joshi and News 18 Network's Vilas Bade and Hari Prasad and discussed A slew of issues making news this electoral season. Prime Minister Modi hit out at the Congress-led state government in Karnataka of misgovernance and also said that the Congress has turned Bengaluru from a tech hub to a tanker hub. Listen in, Chartbusters coming up post that.
So regarding the guarantee schemes, in Karnataka, Congress promised 5 guarantees and they, after coming to power, they delivered that one. They, as per their promise, they are delivering that one. Now, whereas in BJP is more, in the last election, you lost there, only 66 seats you were able to win there, BJP able to win there. Now again, येडियुरप्पा जी का लीडरशिप और उसका बेटा का लीडरशिप में ज़्यादा फोकस हो रहा है. इसका वजह से थोड़ा सा बीजेपी के अंदर भी कुछ लोग नाराज भी है उधर. वो एक्चुअली आपका मन में कर्नाटका में अभी बीजेपी कितना सीट जीत सकते हैं, क्या है?
नंबर 1, कर्नाटका की जनता पश्चाताप कर रही है कि हमने इतनी बड़ी गलती कर दी, इनको बिठा दिया. तो जन समर्थन हमारा कम नहीं हुआ है, जन समर्थन हमारा बढ़ा है. लेकिन इन्होंने इतने ही कम समय में सीएम कौन, अभी भी वो बात सेटल नहीं हुई है. शपथ हुआ है सीएम का, लेकिन सेटल नहीं हुआ है. अपने आप को सीएम मानने वाले लोग बहुत है उसमें. अब कानून व्यवस्था देखिए, चरमरा गई है, बम ब्लास्ट हो रहे हैं, हत्याएं हो रही हैं. आर्थिक स्थिति पूरी तरह कंगालियत की स्थिति में है. वादे तो बड़े बड़े कर दिए उन्होंने और फिर टैग लगाए, ऐसा होगा तो ये मिलेगा, वैसा होगा तो नहीं मिलेगा. मतलब आप जनता के साथ धोखा भी कर रहे हो. जब हमने कहा कि भाई हम इन लोगों को आयुष्मान कार्ड देंगे, मतलब देंगे, फिर इफ्स एंड बट लगा करके उसमें बेईमानी नहीं करनी चाहिए. अभी जब हमने कहा कि हम 70 साल से ऊपर के किसी भी वर्ग के व्यक्ति होंगे, इनको आयुष्मान कार्ड देंगे, मतलब देंगे. आप में ये हिम्मत होनी चाहिए. उन्होंने किसानों की जो योजना थी वो रद्द कर दी, किसान सम्मान निधि. कोई कारण नहीं है इस प्रकार से करने का. अब आप कोई सोच सकता है जब बेंगलुरु दुनिया में हमारा बहुत बड़ा देश की इज्जत बढ़ाने में बेंगलुरु का बहुत बड़ा रोल है. दुनिया में जब जाते हैं ना तो बेंगलुरु कहते ही ऐसा लगता है वो जैसा परिचित है. टैंक हब के रूप में जाना जाता था, आपने देखते ही देखते उसको टैंकर हब बना दिया. और टैंकर में भी माफियाशाही चल रही है. पानी के लिए लोग तरस रहे हैं. अगर ये जो हालत उन्होंने कर दी है, अब युवाओं के स्कॉलरशिप आपने संख्या भी कर दी, अमाउंट भी कम कर दी. यानी एक के बाद एक आपने ऐसे नेगेटिव काम किए हैं. जिन मुद्दों को लेकर के वोट मांगा, उन मुद्दों को आप वोट दे नहीं पा रहे हैं. अच्छा, डेप्यूटी सीएम वो अपने भाई के लिए वोट मांग रहे हैं और वो खुद सीएम बन सके इसलिए सब खेल खेल रहे हैं. वो सीएम से हटे इसके लिए भी खेल खेले जा रहे हैं. जहां तक भारतीय जनता पार्टी का सवाल है, हम टीम स्पिरिट से काम करने वाले लोग हैं. भले मेरी टीम ने मोदी को आगे किया, लेकिन मेरी पूरी टीम काम कर रही है जी. उसी प्रकार से येडियुरप्पा जी हमारे वरिष्ठ नेता हैं, लेकिन काम पूरी टीम कर रही है और टीम मेहनत करती है, लोगों को विश्वास भी है और हम आगे बढ़ रहे हैं.